and amazing. That alone may draw people to New York City. I would want to work in that building, even if we had a socialist mayor. 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 Even if we had a socialist mayor.
There are parts of it that are overvalued, but there are parts of it that make a lot of sense. I know we can't really hear this.
Well, on the CNBC Real-Time Exchange with the big board, it is electric aircraft manufacturer Beta Technologies celebrating an IPO. We're going to talk to the CEO, Kyle Clark, in the next hour. At the NASDAQ, it's Northern Trust celebrating the launch of its tax-exempt bond ETFs. As Jim, we will, for the moment, surrender 6,800.
It's funny, when I saw the futures were down, I got up early and I looked at the futures and I said, okay, now we have to find enough stocks that will be down in keeping the futures, because what happens otherwise is the futures. That's hard for me. I really want to do my job well, and that's hard for me. The futures, what happens is that they go down, and then we need to have enough stocks that are bad, so we need more Zoetises, we need more Wingstops, we need fewer Spotifys, and we need fewer Yums. And I think that in the end, the futures should not be do not control this market. But David, there's a lot of people who say we were due. Where were they 2 days ago when they didn't think we were due?
I don't know where they were.
Where'd they go?
I don't know. Maybe they were using their flying car.
Maybe they were at Alpha. I don't know. But I'm thrilled. I want everyone to go public who can go public. I took the company public. It was great. But I also did not try to make it so that I have even less hearing than I have right now.
Well, you and David just covered Pizza Hut at the board. You could tie in there, take private at Denny's. We heard about Starbucks China yesterday.
I gotta tell you, I was surprised that I want to know whether Jensen Huang wants to get in there and buy Denny's instead. Come in there with a $7 bid. That was Jensen's formative days.
Yes, cleaned a lot of toilets, as he once said.
Yes, he did. He and I were both bus boys, and at one point he was a dishwasher. I said, my father said, if you're ever a dishwasher, that's really beneath you. I've washed a lot of dishes in my time, too.
Speaking of Jensen, the Journal does take a look at how his lobbying for the China sales ran into a brick wall when it came to the Secretary of State and some others.
I think that there was this unfortunate dichotomy between either the best or the worst. There were plenty of chips that I think would have made it so the Chinese were still on the hook to us, but I know it became globalists versus non-globalists. And Jensen's really perceived as being the ultimate globalist in Washington. I think his view was, if you let them write on our software, we'll be more powerful, and that they were never going to use us for defense anyway. But I think both sides had decent arguments. I came down with Jensen because I thought he was more persuasive. The other guys, I just think, are just saying, listen, they're not going to get it, so we'll keep it from them.
It is interesting that he is more open to selling to China, even though he himself is Taiwanese,
yes,
which we all agree is facing potential existential threats.
I know that when you speak with the Peter Navarro contingent, Peter's been rather quiet in the White House, he would say that, listen, that he's the foremost globalist of our time, and I would say no. If you listen to him, what he's saying is, if you want to know what the Chinese are up to, have them write on our hardware. And I thought that made sense. Hey, I've got a stock that's up. I want to see if David knows it at all. David, when sometimes stocks are so down so low, they look up to me, and that's Clorox.
Clorox. God, I can't remember the last time you mentioned that name.
It had a horrendous quarter.
Yeah.
Absolutely terrible. They had this ERP that just obliterated their earnings.
Yeah.
And the stock's up too because it was just down so much. Enough is enough. And by the way, David, I'm going to go one step further. I think that Michael Hsu, Kimberly Clark is down so enough is enough.
Actually, I wanted to go to Kimberly Clark.
Did you?
Yeah, because you had him on as a guest last night.
Yes, I did.
I did not watch. I heard very positive reviews of the interview, Jim, that you asked salient questions.
I couldn't hear that. Over the crowd, I couldn't hear that.
That you asked salient questions, that you really knew what was going on. So well done.
Next, you're going to say you're going to accuse me of doing homework.
No, I'm telling you a nice thing.
I know, I appreciate it.
And you can see, that said, you interviewed him after the stock went down 15% yesterday, in part in part on concern about the liability
Right.
from Tylenol, which, as I pointed out yesterday, is carved out from the material adverse change clause in the merger agreement. I'm curious as to what stood out to you, and we obviously do have some sound from it.
I think that Kimberly-Clark is a very well-run company when it comes to the two most important channels in the world, the club channel and the e-commerce channel. Kenvue was probably the worst when it came to those two. It had no strategy whatsoever. I think that Michael Hsu recognizes
none of them. I mean,
that the case law is really on the side of Tylenol. And he's willing to have it litigated again. He also recognized, by the way, that J&J, when they decided to take on every single one of the plaintiffs when it came to talc, stock went from 150 to 190.
Let's take a listen to Mr. Hsu on Mad Money last night.
We're really excited today. This may be the second most important day in our company's history. Of course, Founders Day is the most important. But this is really about two great, iconic American companies joining forces to create what we think is the preeminent global health and wellness leader. And so that's really what we're trying to build.
There it is.
You're dealing with a company, David, that is now going to be bigger than Unilever.
Yes,
which would really be incredible.
We made those points yesterday, and obviously the holy grail is you get a multiple at some point approaching that of P&G,
exactly right,
and then you are certainly going to be rewarding your shareholders. At least it seems to be perhaps finding a level.
So I think that Hsu's doing a really good job in it. This is an example again of the people say the market's really expensive. Kimberly-Clark is a premier company with a great brand. It's 14 times earnings.
Yeah.
Look, what's expensive in the market, even like the SanDisk and the Western Digitals and the Micron, they're not expensive. The numbers come through.
Right.
What's expensive tends to be enterprise software.
Right.
That's still expensive, and it's always been expensive. This stock is very cheap.
Another stock that we haven't mentioned this morning is Tesla, guys, and it is down 4%. It's been having a nice rally of late. I'm sure our viewers are well aware. Up about 11% now for the year, dipping just below the $1.5 trillion market cap level. Norges Bank, which is the sovereign fund of Norway. I mean, if you do it on a per capita basis, the amount of assets they have in that fund versus the number of people in Norway, I think they can basically live on for generations without ever working. But they are voting against what could be as much as $1 trillion pay package for Mr. Musk that all shareholders will be weighing in on, or those who choose to, and we'll find out the results of this vote at the annual meeting on Thursday. Remember, it is only if Tesla were to get to an $8.5 trillion market value that Mr. Musk would then realize the full amount of that pay package, which would also take him to roughly 25% of the shares outstanding. And that's something he has said numerous times he wants. He doesn't feel like he has enough control at roughly at 12% right now. He is able to vote those shares, I believe, in favor of his own pay package. So that's going to be helpful. We'll see how this all works out. We'll know the numbers on Thursday. Robin Denholm, the chairman, has, of course, been advocating very aggressively in favor. She was a guest on Squawk Box last week.
Meantime, China made EVs down 10 in October. I think Italy was down 47. We continue to see these crazy percentage losses in Europe.
Incredible. By the way, I wonder whether the American automakers are thinking that we are now at a permanent ceiling without any sort of subsidy.
Without any subsidies. It's going to fall dramatically. The $7,500 tax credit has gone away now.
Right.
It did result in a higher spend or higher rate of sales right towards the end.
Yes,
certainly.
it did.
But we'll see what normal looks like as in the months ahead without that credit.
I'm surprised the stock's only down 18, given the fact that the numbers aren't that good. But remember, it's also not really trading on being a car company.
It's not about.
Although you have Uber out there talking about.
It's about humanoids, it's about robots, and self-driving. That's
right.
That's where Mr. Musk is focused.
I think that's
the attention of shareholders, and that's where he's going to have to deliver.
Did you see the Jonas note this morning?
Yeah.
I bought myself a humanoid robot.
I did see
Jonas
that.
Is so much.
The weird part is, until it's fully autonomous in a sense, you have to acknowledge that some human has eyes on your kitchen or your bedroom as long as it's operating inside your house.
I was talking to Tim Cook, CEO of Apple, about the Vision Pro, which is what they're using, and it's kind of interesting because it's a let's put it this way: that you think that Alexa knows a lot about you. I mean, this thing, David. They know whether you're wearing boxers or briefs or nothing.
Well,
This is like commando. I want to know whether he's commando.
The guy standing next to the lady doing the dishes was weird. That one.
Well, the dish. You see how long
By the
Joe
way,
is?
he looks pretty buff. That robot.
No, that's actually
That's Jonas.
Wait. Oh, is that Jonas?
This is Jonas right here.
Oh, he's in the.
Yeah, not pictured robot.
Got it. But not.
Adam's he hasn't been missing buys and tries.
I got to tell people that when you meet Jonas in person, he's every bit as exciting and thoughtful and imaginative as you could ever imagine.
We
Just
also
terrific.
did, speaking of autos, Jim, we got race, which, we talk a lot about the luxury end holding up, but shares are negative on the year.
Well, that's something.
I mean, Ferrari's been great. You take a look. There it is.
It's been a winner for so long. I think it's okay that it takes a breather.
It did get hit on that day when they took in their ambitions in terms of electric vehicles.
San Mita, by the way, up nicely, so it's not like everything's...
Spotify's down about 4.5% after earnings, Carl, and they again look to be paying good. I think they had a price hike in the UK, but stock's down about 5%.
Revenue up 7 was a beat. Paying subs up 12. Not bad.
No.
Yeah, this stock has historically not acted well on the day of that it reports. It was up 20 at 6:30. It's highly erratic. What are you trying to signal?
I'm trying to signal Casey, but she always is very busy. There she is.
Hi, Casey.
Is this ready?
I had so many Caseys
right.
in my left, I can't keep track of them.
Really quick, the other good one in at least audio media is iHeart, as these reports that Netflix is looking to license some video podcasts.
I thought that was interesting.
Yeah.
Look, everyone wants kind of a piece of NVIDIA. We're seeing a lot. I don't want to talk about Eaton yet because
That's
that's
going to be, well, it was up double-digit pre-market. I'm just looking back. It's going to take you on iHeart highest since 23.
No, they did have some. They were some pretty bad financial problems at one point. Good for them.
You want to tackle travel? NCLH is, I think, the only major cruise line that's red for the year.
Yeah, but when we had Royal on Jason Liberty, people were saying, listen, be careful here. Because what's happened is that they're not filling up their cruise lines as fast. There's a mad rush at the end to fill. And a lot of people kind of said, but it was still good. But the stock has not had a single good day since, well, maybe there's been one or two. But this group has lost its luster. This was the last big travel group. And you don't want to see them lose it. And this, again, is what I'm thinking, government shutdown. There's also this notion of this Melez notion, Jimmy Carter Melez. David, there are people who are just a little bit, they're not spending. And I don't know whether they're not spending because they're saving or they're not spending because they're worried about the world or they're worried about the shutdown.
The narrative has been consistent, which is the lower-end consumer is stressed. They have been for a long time.
Spending on cruise.
But everybody else is doing okay. So you think that's changing?
No, I just think that there are certain things that people who are not doing that well still spend on. And cruising was one of them. It's a great bargain. It's a great bargain versus hotels. And it's just the numbers aren't bad, but they're not great. No, we're looking.
Marriott was okay. Up today.
Marriott.
They guide for a little bit of improvement in RevPAR this quarter. But Jim, a lot of that strength is coming out of international. At least on Marriott.
Marriott is incredibly well run, and we don't talk about how well run it is enough because you can set Marriott and American Express are two companies that chronically people say, oh, listen, this is the last good quarter, and chronically they deliver, and I think that's because they offer very seriously good product, and people think it's value. The perceived value nature of things, people feel that Marriott perceived value. American Express, I think, does offer great value. A lot when you take with Starbucks, and we'll get to Starbucks. Like I'll say, whose loyalty program? Who do you emulate? I mean, people just want to emulate American Express. They do a great job. They're points. Now Starbucks, I would point out there's a very big confusion about how much they really got out of China.
Yep.
All I care about is they don't have to worry about China anymore. That's what I was excited about. But people felt that they were going to get more when we had Brian Nichol on last week, and he didn't deliver. I don't know. It's splitting hairs. I really don't think that the valuation that they got is anything bad. What I care about is I just didn't want to. I didn't want to worry about China anymore.
The reaction, the response to earnings this morning generally has been fairly negative. Whether
For everything.
Yeah, Uber is another name, down
I didn't-
8.5%.
No, I didn't think Uber was
on
that
those
bad.
numbers. And
you
again,
think
we
it was
can
that
always sit here
bad?
and say they're not that bad. But again, is it reflective of that many of these stocks are priced for perfection, so to speak?
I think that we overall came in this morning, and everyone, it's almost like people decided, okay, if Palantir is being reconfigured, let's challenge everything. Palantir's been the big winner. It's been the bellwether. I know you say he's in my mind, but it has been the big winner of this period.
Yes.
Look, I find that we're going to look back and say, all right, so the P's were really high and stocks are coming in. Give it a couple days, and then the buyers come back because it is seasonally a great time. I don't see the inherent overvaluation that people keep talking about because there's a lot of companies that are selling it very low multiples.
Yes.
There's a couple that are selling at very high multiples.
And this is one of them, but it also has growth rates that are truly astonishing, 121% year over year in its commercial business.
When I used to try to teach how to value something at Goldman, this would be one I'd say, like, look, you have to understand, this is, some people say it's a cult. It's a cult.
Guys, I do have
better
one name that is up on earnings this morning.
Give me the category. Give me the category.
Apollo.
Apollo,
yeah.
Private equity company?
No, it's not private equity. It's an alternative asset management,
Alternative
private
asset
credit.
management?
Private equity. What century are you living in?
Oh, I like Apollo. You know that. I think they're good.
Apollo is up over 5%.
I think they're good. I like
They are
Carlyle,
nearing
too.
$1 trillion
I like
in
Carlyle.
assets under management. Where are they at?
Inexpensive.
$905 billion.
How could that only be an $75 billion
Now, this
company?
stock, of
What is
course,
that
has
about?
been hit this year. You know, as there have been a number of questions, perhaps around private credit, but also many of the alternative asset managers actually suffered as much of the market did around April with Liberation Day and never fully recovered. And then recently, the concerns around fraud, even though they really didn't apply to the private credit market, but around First Brands and that tricolor, have also depressed some of the group. Responding positively to the numbers, Mark Rowan, of course, the highly articulate CEO of Apollo, was on the call talking about those recent blow-ups. Take a listen.
If you look at the recent blow-ups, and we all know the various names, almost all of those blow-ups have taken place in credits underwritten by the banking system. So it is not, as I said, that we have public credit and private credit. We have credit. The difference between public credit and private credit and bank credit is literally whether it is syndicated or not. There are good banks, there are bad banks. There are good asset managers, there are bad asset managers. There are good insurance companies, there are bad insurance companies. I don't think we're talking about systemic risk.
So there is Mr. Rowan, not systemic risk. I think that ended up being the conclusion of many. We almost seem to be out of that period that lasted a couple of weeks.
Well,
that said, questions about underwriting standards, and we had Mike Arrighetti, Carl, here yesterday from Ares sort of responding to that as well.
I mean, the Fed did inject another, what was it last night, Jim? Another $24 billion in short-term liquidity. People are talking about that.
No, they are. And I know that there's always going to be people who say that there's something bigger that's lurking.
Well, the cockroach still is out there from Jamie
but
Dimon.
I thought that Rowan was right. There are bad lenders. That was good. Yeah, you're right. Jeez, I didn't know that. Something about his dog.
Not DraftKings or Flutter.
That's Sarah. What do you mean?
No,
Come on, you want to read it?
I thought it was Eaton.
You want to read it?
Oh, I got that same one.
Yeah.
Got about 10
No, you
minutes before
didn't get
did.
that same one.
Look, I thought I like this guy Rowan. I don't know him. I like him.
We
all right.
We gotta go.
What?
We gotta go.
Tesla.
Watch bonds today. It is going to be busy. We got some Fed speak on the tape, Bowman included. DXY, by the way, 3-month high as we get past 100. 10-year, though, is backed off of yesterday's 412-ish, back to 408. Don't go anywhere.
Shares of Shopify moderately lower this morning, despite reporting a Q3 sales rise by nearly a third, showing strong merchant growth on the platform. The stock's been way up since we had Harley Finkelstein on last, and now we've got him again. Shopify President Harley Finkelstein. Harley, it's great to see you. Thank you for coming on with us.
Great to be here, Jim. Thank you.
Okay, Harley, I think a lot of people want to talk about small, medium-sized businesses to get started, and of course I do too because I care about that. But I was noticing that now you really do have a preponderance of the consumer packaged good companies, biggest ones like Estee Lauder. I mean, that's not something I would expect on Shopify.
Well, let me start with something that I know that is near and dear to your heart, which is that every 26 seconds, a brand new entrepreneur gets their first sale on Shopify. And I think this quarter, we matched that relentless momentum across the board, 32% GMV growth, 32% revenue growth, and an 18% free cash flow margin. And I think last time I was on the show, I told you, Jim, what we do is we build great products, we ship relentlessly, and we grow consistently. And that's what we did. And that's why everyone from small startups to giants like Estee Lauder or David's Bridal or Michael Kors are choosing us. And I think Q3 was another quarter of very strong growth and consistent profitability.
Absolutely. Now, there was a lot of shadow boxings last time, and the stock was dramatically lower. People talking about that the cash flow was depressed. Once again, they're using that same canard. I don't buy it at all. What I want to talk about is why are merchants choosing you? What do you do that makes it so that someone can quit their job and live their dream and not have as much risk as if they would have, say, 10 years ago?
Yeah, look, I think we're also in this new era of commerce where it's not online or offline. It's sort of everywhere. And I think one of the things we're very excited about is AI. I mean, AI is this new tool for us and what has always been our goal, which is to enable more entrepreneurs around the world. And what we're really doing with AI is laying the rails for agentic commerce. We've been building this, this infrastructure to build shopping into AI conversations now for years, and now working with companies like OpenAI and Perplexity and Microsoft's Copilot. It means that more merchants can sell in more places. And so this idea of these larger brands coming to Shopify is really about them future-proofing their business. They want really good value, but they want to know in their boardrooms when a board member says, what about AI? What about agentic commerce? They can say, well, we're with Shopify. We know they're going to make sure that we're everywhere.
All right, so what does a Nestle's need with you? I mean, Nestle's has got one of the biggest ad budgets in the world. Why do they have to mess at all with Shopify?
I think a lot of these companies, especially the larger ones, either have built their own stacks internally in-house, which obviously means they have to run their own servers, they have to run their own technology. And what we're seeing is that a lot of these very large enterprise brands, they don't want that anymore. They want to modernize. They want to effectively come to Shopify to say, you guys handle my commerce, my retail, let us build the best products that consumers love. And we're seeing that clip happen. But it's not just happening in one geography or one vertical. We're seeing it happen in automotive, in CPG, of course, in apparel. And when you look at the brands that consumers love, the ones that consumers are talking about, all those brands are on Shopify, which is why right now we have about 12% of e-commerce market share in the US. And generally what we're seeing is that Shopify actually outpaces the overall e-commerce market. And we're going to continue to do that. And if we can do so while growing top line, above 30% and also being operationally disciplined, I think we have this incredible company that, again, we've been working on for about 2 decades now.
Now, there were about a half dozen companies that competed with you in America at one point, and now I detect from people who are starting businesses that there really aren't any. You can go to Amazon, which is very difficult, although you have a relationship with Amazon. But what did you do that made it so that the other guys just couldn't keep up?
This is about simplicity. This is, if you know how to, if you know how to use email, you can set up a store on Shopify in under an hour. So the idea is to make it really easy, which is why every 26 seconds, I mean, while we're talking here, 4 or 5 entrepreneurs got their very first sale. Now, what's unbelievable in this particular climate, this sort of golden age of entrepreneurship, is that some of those businesses are going to be some of the largest companies in a decade or less. And they're going to start on Shopify, but they're also going to grow on Shopify. And when you look at Alo or Viore or Gymshark, these are homegrown success stories that started with us. And so it's not just that we're making it easy to start, but as they scale and they want to sell on social, they want to sell on marketplace, they want to have online and offline, that's all being done on Shopify. And I think our results prove that we're doing that with incredible velocity.
Well, thank you, Harley. I know that there are people who feel that AI is going to wipe a lot of jobs out. I'm going to look to companies like you to be able
Huge
to create
opportunity,
far more jobs.
Incredible opportunity. Absolutely. We're very excited about it.
All right, Harley Finkelstein, those who have used Shopify know that it works. Thank you so much. Good to see you, sir.
Good to see you as well.
Jim, what's the plan for tonight?
All right, I've got AGCO on. I've got to find out about the farmers. We know that the farmers are integral to what happened. Look, we decided to trade soy, but not chips. right?
Yes.
What we said.
Yes.
Some soy,
And a little
but not
wheat,
chips.
I think, yesterday. Some
Yeah, but
news
some
about wheat. Yep.
I'm not giving up on the idea that they're my chips. It's just that everyone just looks at the Grace Blackwell. I'm talking about giving the Grace Blackwell. I'll take the Vera Rubin and the Richard Feynman.
Well, Besant this morning on Squawk said we could maybe do it once they're outdated.
I find him pretty cool. I don't know why. Like I said, stop. I gotta listen to this guy.
Jim, we'll see you
Right.
tonight.
Thank you.
Mad Money, 6 p.m. Eastern Time. As we get a little bit of buying off the opening low, Dow down 200. Stay with us.
Good Tuesday morning and welcome back to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live at post 9 of the New York Stock Exchange. Stocks right now are under pressure. The S&P is down 0.6%. We've come back a little bit, but the NASDAQ is getting hit harder. It's down 0.8. Two spots that are working, financials and real estate. Everything else is lower. We've got a lot of earnings to talk about, but at the bottom of the pack today, you have energy, industrials, and information technologies. As for treasuries right now, we'll show you what's going on. Again, we're data light here in the middle of the shutdown, but there's buying of safe haven treasuries, and that's pushing yields lower. We've got the 10-year now back below 4.1. That's where it ran up to after Powell last week. So that's reversing. Today, Goldman Sachs chief U.S. equity strategist David Kostin will join us with his take on this renewed volatility and the one potential red flag for the market from earnings season so far. And then speaking of earnings, Palantir getting slammed this morning despite strong results across the board. We'll take a look at what's driving the move. It's down almost 7%. And then a titan in the sports world. We will be joined by Ted Leonsis, the owner of the Washington Capitals, Wizards, Mystics, as team valuations keep rising and ratings hold strong. But guys, since we don't have the official data what we do have, we are blessed with a ton of earnings and from all different kinds of sectors. So I pulled out some key quotes about what companies and CEOs are telling us about the consumer right now. And it really varies by industry. For instance, look at Clorox, Linda Rendell of Clorox. And this is where the consumer pain is really being felt in some of these staples companies. The consumer continues to be under stress, definitely reacting to the level of volatility and uncertainty that's out there. And we're seeing that in their shopping behaviors. Remember, David, when I warned you about Kenvue yesterday? When consumers don't pay top dollar for the high-end brands, the consumer staples feel it. And so Clorox is an example of one as well. But, you know, it's different if you're in the travel business where, for instance, Marriott CEO Tony Capuano, high-end consumers, he says, have demonstrated resilience to macro uncertainties and continue to prioritize travel. So they're not prioritizing Kleenex, right? Clorox bleach or whatever. And they are prioritizing travel. And that's kind of a continued theme. High end, low end is also obviously a big one as we get through some of these earnings.
Although we did see Norwegian suffer today.
Yeah, that was a revenue miss.
Yeah.
Although the numbers were quite good and the commentary on travel.
You can see that's actually it's worsening now,
bullish.
down almost 12%. Yeah.
Contessa's going to talk to the CEO and we'll hear from him a little bit later. But, you know, some of these stocks are also very priced for perfection. They've had such tremendous run-ups. You know, Yum Brands they have their news on Pizza Hut, obviously, which is moving the stock. But as far as what they're saying about the consumer, we're not seeing the consumer pull back in the Taco Bell business. We do think the consumer in the U.S. is cautious, but incredibly resilient. So that's what you're getting. A lot of these executives acknowledging the caution, the volatility, the uncertainty, but also the resilience on the other end. Uber CEO Dara Khosrowshahi was on Squawk Box this morning. I thought pretty bullish about what they're seeing from consumers. Listen.
When we look at our results in terms of the high-end consumer or the more budget consumer, they both continue to grow. We're actually now penetrating increasingly outside of the large cities. And our growth rates outside of the large cities and some of the sparser geographics that we're going after are 1.5 to 3 times faster growth than in the big cities. So we're not seeing consumer trends one way or the other change. They continue to be strong.
That's good. I mean, it's a vote of confidence. And he even mentioned that's at the high end and the low end. We'll get consumer confidence numbers later in the week, Carl. University of Michigan out. So maybe a better read on that. And services data later in the week as well, which is always key because that's the biggest part of the economy and also can speak a little bit to demand.
Street might have been a little disappointed that they guided Q4 gross bookings essentially in line. Also said that robo-taxis wouldn't be profitable for a few years as people try to get their hands on when that holy grail gets in hand.
Yeah, and there's the stock reaction, but also another example of a stock that has just run up so much, which I think is a theme, right, of what's happening in the market right now. There's no room for discipline. Look at Palantir, for instance. There's very little room for error. I'm just saying, if you look at some of the macro threads coming from these earnings, so far pretty good.
Yeah, I mean, we had a discussion about the sort of bifurcated market. A third of the S&P is 20% from the high, essentially in what we would call bear market territory.
Yeah,
a full third of the S&P.
It's not all inclusive, right? That's the concentration risk that we talk about when it comes to questions about whether it's a bubble, whether it's sustainable. I mean, no. David Rosenberg was on talking about how difficult it is for active managers.
If you're not right in the right space, it can be painful. By the way, the market rally taking a little bit of breather today, although, as Sarah said, we're off the opening lows, including this drop for tech. She mentioned Palantir pulling back despite a strong report last night. Part of a trend, according to Goldman Sachs, which found that investors are not rewarding most earnings beats as much as they have historically. Let's bring in the author of that report, David Kostin, Chief U.S. Equity Strategist at Goldman Sachs, who, I don't know, have we had a chance to congratulate you on your retirement, David?
Well, it's coming at the end of the year, but I have a colleague who hired 15 years ago, Ben Snyder, who's an excellent analyst, and he's going to be succeeding me. And it's been an honor to be at Goldman Sachs and be the U.S. equity strategist for a long time.
We've had him on a few times, but you're going to be tough to replace. On earnings, you want to walk us through beats, rewards for beats, what you found?
Well, I think the conclusion for the third quarter results, basically they're strong, better than expected. You can think of that a couple of ways, Carl. You can think about year-over-year growth of around 8%. expectations coming into earnings season was 6, so it's a positive surprise relative to expectations. The breadth of positive surprises, about 65% of companies beat expectations at the highest level in a couple decades, other than during the pandemic. And the issue to think about is that the surprises have not really been rewarded very much, something you alluded to just a minute ago. And I think that's the issue that a lot of investors had already maybe anticipated there would be some positive surprises, and the fact that the positive surprises were smaller than they have been in the last couple of quarters. Usually it's about 400 basis points, 4 percentage points. It's about 2. It was 8 versus 6. Right. So not as dramatic. I think that's also a concern about some of the underlying fundamentals. And managements, though, have been generally pretty optimistic on the outlook for the rest of the year and into next year. I think that summarizes pretty much the earnings season.
Eight's pretty good. It's not 11 like we had last time.
Correct.
What are you looking at for Q1?
Well, the expectations Q4 and into next year, we have some modest earnings growth, maybe 7%, probably maybe if distribution of risks around that, probably a little bit low, but modest growth, pretty much in line with economic activity. Think about real GDP in the vicinity of maybe 2%, nominal GDP 4 to 5%, depending on where inflation comes in. That's mostly what companies report in terms of their revenues. They have a little bit of operating leverage. Maybe that gets you some buybacks as well, and then gets you the kind of 7-ish%. That's sort of the building blocks behind an earnings growth for next year.
Right. We did have Joseph Briggs on the other day talking about whether or not this AI build-out is sustainable. He argues yes. I assume that matches the House view.
Well, I think the issue is, from an economics perspective, there is extraordinary impact that the AI will have over time. I think as a market strategist and an investor, I think there's, Carl, there's sort of 2 parts of that market. One arguably is in a bubble, and one is not. And I think you can think about that in terms of the price and capital availability. Price, capital availability. They're 2 different markets. There's also public and private. So let's go through a couple of observations. If you think about public market price, NVIDIA stock is up 13 times since 2022. Its earnings are up 13 times. So you would say, well, the earnings have tracked the share price. If you think about the valuation of some of the biggest stocks in the market, they're 30 times now. In 2021, when real rates were negative at the time of the pandemic, they were 40 times. And in 2000, 25 years ago, they were 50 times. So 30, 40, 50. You could say they're not, in the public market, price to reasonable. Think about capital availability in the public market. You can think about 50 IPOs this year. There were 250 IPOs in 2021. There were 400 IPOs back in 1999. So the point is, the capital availability in the public markets is there, but it's not necessarily excessive.
So where is the bubble?
So what you think about, Sarah, if you think about the private markets, and I think the intuition or the observation here, again, there's the economy and then there's the markets, is George Soros. He wrote 40 years ago the book, The Alchemy of Finance. The Alchemy of Finance. And his insight at that time was that when you think about the valuation of a stock, most people think of it as the discounted future values of the cash flow. That's how most people approach it. But his insight was that actually the valuation of the stock today is also a reflection of how the share price has performed. And the idea of this theory of reflexivity is how he described it. He describes it, Chapter 2, The Alchemy of Finance, reflexivity in the equity market, Chapter 3 in the currency market, Chapter 4 in the bond market. He talks about how prices change. And the idea is that the availability of capital in the private market, being able to bring in new capital is inherent in the valuation of the companies. And that sort of circularity, not the circularity of external financing, but rather the ability of these companies to keep growing based on their ability to attract new capital, is itself a source of the valuation. And now the question is, can that be delivered upon? Is there a return on that capital? And to the extent that there is, then those share prices will be validated in the private market. To the extent it's not, you'll have a negative reflexivity. And that was the observation. George Soros wrote this.
That's a very complicated way of saying it. Sounds like that
you want to go to a party where it looks like it's hopping, right?
He raises, he invokes Karl Popper. It's very philosophical. But the idea, the insight that he had, this reflexivity spirals up. And then when and if that doesn't get realized, then it goes down in the other direction. That would be the risk. Now, you don't know if the bubble happens till looking backwards, not looking forward. So it has some of the attributes we saw 25 years ago with respect to vendor financing, certain circularity of the financing, which I know you've talked about in the past. But I think that's an important construct. So my answer to your question about AI is, in the public markets, there's still price and capital availability would support the idea of the share prices, validates the share prices, if you will. But in the private markets, it's still to be determined, and we won't know until after the fact.
So when the Journal runs an op-ed that says there's a private capital winter coming,
right? You
agree?
Well, there's private capital. Some questions about the return of capital, the distribution of capital in the private world. We had a conference at Goldman Sachs in California 2 weeks ago. That was a big topic. We had 100 senior executives in the private equity and the venture capital world, and that was a question. There needs to be some return of that capital, the DPI, the distribution of paid-in capital, and to the extent that that is not coming as quickly as some of the asset allocators would desire, that question's how much further, how much more capital can get pulled in.
So should people buy the dip when you get pullbacks like this?
The answer is yes. In this environment, we're not having a recession. The Fed is likely to cut in December and then twice next year. It's our economics team, and that forecast would be generally supportive of equity prices moving higher, and that's the
bubbles in the private.
And the concern, and just be very clear about this, the bubble, you'll never know in the bubble until you look backwards. And at the present time, some of the attributes that I identified would be some areas of concern that I have.
We're going to see you again before the end of the year, I hope.
Yes, we will.
Okay. Hopefully more Soros.
And he's getting philosophical here in his final months. I like it. I like it, David.
David, thanks.
Thanks for having me.
David Kostin.
Here's our roadmap for you for the rest of the hour. When we come back, what's behind Palantir's pullback? We'll look at Wall Street's downbeat reaction and what CEO Alex Karp just told CNBC about the investors who are shorting his stock.
Plus, the air taxi maker Beta Technologies went public here at the New York Stock Exchange. We're going to talk to the company's CEO ahead of the first trade.
And sports investor, Washington Capitals and Wizards owner Ted Leonsis will be with us to talk about sports valuations, media rights, and more as we continue on this Tuesday.
We are over 30 minutes here into the trading session. The Dow just touching session highs. It is coming back from an earlier dip around the open, so that dip is being bought. Here are three big movers we are watching. Biotech company Sarepta Therapeutics getting slammed in early trading after disappointing trial data for its muscular dystrophy drug. Apollo Global jumping this morning. Q3 earnings beating estimates as assets under management swelled to just shy of $1 trillion. The firm's loan and direct lending business helping to power results with fees rising 33% from a year ago. And then Palantir falling despite a solid report, earnings and revenue coming in better. The company raising its current quarter and full year revenue guidance. For more on Palantir's move, now down about 7.5%. Let's bring in Seema Modi. Seema, and the CEO had something to say about it as well.
He sure did, Sarah. Palantir CEO Alex Karp joining CNBC in the last hour and addressed the stock reaction despite a very upbeat fourth quarter outlook. And he also had a strong message for short sellers, calling out Scion's Michael Burry after a 13F filing revealed the big short investor had bets against Palantir.
I'll tell you why the short sellers are constantly getting screwed by Palantir. Because every time they short us, we just are like tripling down on getting the better numbers, and part, honestly, to make them poorer.
Now, the street reaction this morning has been overwhelmingly positive. Morgan Stanley upping its price target from $155 to $205 a share, saying it is hard to find a better fundamental story in software than Palantir right now. Cantor Fitzgerald keeping Palantir at a neutral rating only due to valuation. They're citing the growth that Palantir is seeing in its artificial intelligence platform. Palantir is currently the most expensive company in terms of price to sales ratios in the software sector. And when asked about valuation, Karp pointed to Palantir's run rate and that 121% year-over-year surge in commercial. And that is due in part to Palantir's success with boot camps that are essentially helping train clients on how to use its technology real time. Karp on the call said that faster AI adoption with total customer count increasing 45% year over year and contract sizes with new deals of over $10 million, up 3 times. Right at this hour, shares of Palantir are down about 8%, but still up over 154% this year. Key topics I think investors are going to keep an eye on. One is capital returns. We didn't get any signs of a stock split last night. And then its ability to scale its partnerships with customers overseas. Karp on the call did call out growth in Europe being, quote, stagnant, guys.
I actually thought he was tame. Last year in an interview with me, he called the short sellers like drug addicts, and that he was like their coke dealer, trying to take it away. But clearly, look, he's a champion for this is a retail stock, and when you look at some of the gains that Palantir has had over the last few years, I mean, it's really retail based, and I think that's been sort of the message, and I wonder what the commentary there is today, because it's never one that's easy to follow, Seema. When you look at some of the analyst commentary and report, they just don't get excited about the valuation.
I would encourage everyone to read the transcript from the earnings call last night, Sarah, because there was something there for investors, but there was clearly a message he had for the retail community as well, why he thinks Palantir's technology is really empowering the West, how their software is helping the military find and target the bad guys and make decisions in a faster speed and a faster timeline. He also talked about why the company is taking a stance on certain political issues and why they're working with ICE and trying to find those alleged drug boats coming in from South America that are bringing in drugs. So there was a lot to say there, and I think that's where he stands on how he's trying to sort of create enthusiasm amongst those in the retail community, guys.
Yeah, he's certainly a unique voice and not afraid to use it as well. Seema, thank you. Seema Modi. When we come back right here, electric aircraft maker Beta Technologies making its public debut right here at the New York Stock Exchange. It raised $1 billion after pricing just above the range, $34 a share. CEO is going to join us next. And that bidding war is still going on. In fact, it's heating up for the obesity drug development company Metsera. First it was Pfizer, then it was Novo, then it was Pfizer, now it's Novo. We got a lot more for you on that. As you see, that stock price up 15%. We're right back. We are awaiting the first trade of Beta Technology. It's an aircraft maker, pricing its stock at $34 a share. That was just above the indicated range, raising over $1 billion. Joining us right here at Post 9 in a first on CNBC interview is the company's founder and CEO, Kyle Clark, and Morgan Brennan here as well. Morgan.
Hey, David. And Kyle, it's good to have you here. Welcome.
Great to be here.
So you had an upsized IPO offering. You've priced above the range. Why take Beta Technologies public now?
You know, it was always the intention of the company, and we had 4 things that we had to get to before we went public. We needed to be in production. We needed to have clear cost of bills of materials, a pipeline that we could fulfill to provide good guidance to the street, and we needed to have a major certification under our belt. And at that point, we knew we would take this next step that we always knew would come. We didn't know the date certain, but we knew those milestones had to be in the bag.
So you've already developed 2 aircraft. I actually saw one of them a couple weeks ago at the Up Summit. How quickly can you produce them and deliver them to customers?
Well, so we are delivering aircraft right now. We have operations down in New Zealand and up in Norway, and these are pilot programs with customers that have taken the aircraft for early delivery and trials, and they're doing real work with them. We will ramp that through this year with the executive order. It accelerates our path to market, and as soon as mid-year to the end of the year next year, I think you'll see a bunch of them flying domestically for real customers. This year, we've been doing trials all over the country. We've got aircraft out in Seattle and Vancouver, down in Ohio, flying right now.
So you build the aircraft, you also design the charging stations, you also focus on propulsion systems as well. There are folks out there that say electric aircraft, electric aviation, this is a niche market. How do you respond to that?
Well, it is right now, and it's growing. Like every year that we do this, the range goes up, the payload goes up, and the applications go up. Our aircraft now are flying in all-weather instrument flight rules, doing real missions that our customers need done. So the niche market is a product of the performance of the aircraft, which is improving at an astounding rate as a function of power electronics and battery energy density. And when you compound those together, I mean, we set the world record for the longest battery electric flights, 336 nautical miles. I was sitting in that seat for nearly 3 hours. That's too long. You've already exceeded the range necessary. You know, if you fly with UPS or Amazon or Bristow, they actually need to go much less distance. So distance check is done.
How do you differentiate yourself from the Jobies and Archer Aviations of the world?
Yeah, we've really focused on first principle physics design, a simple design that is reliable in all weather, and a business that has this stepwise approach to production, manufacturing, and certification. You know, we took this company public in a regular IPO, in a slow, methodical process. Our S1, our registration statement, was clear in first principles. Our designs are clear in first principles. We're going to cargo, medical logistics first, and then to passenger. And I happen to believe in this path, we will go faster and more efficiently to the markets of urban air mobility.
Path to profitability, what does that look like?
But we're continuing to produce these aircraft at a higher and higher rate, which is driving our cost of bills and materials down. We're including engineering, not just on the product, but engineering on the processes as a major part of this investment to further drive the cost down. And right now, our unit economics for us as a contribution margin on products like motors and chargers are already there, and we're going to get there on the airplane.
GE, a couple of weeks ago, made an investment into Beta Technologies, also became a partner. What does that enable?
So GE, just a spectacular leader in the aerospace industry. Larry Culp, a thoughtful, long-term thinker. So it enables us to align with them on certification strategy, on the introduction of electrification to more traditional jet engines, in some cases a turbo generator, and then enhancing the electrification component of all future propulsion systems because of the efficiency and reliability benefits. It enables us to lean on a very respected and experienced company as we grow into the next phase of our business. And, you know, personally, Larry has been a good mentor and a thought partner on how we do that.
Government shutdown. We don't have very many IPOs coming to market right now, but you are. Has it impacted this process for you? And perhaps just as importantly, has it impacted your business since you do contract with the military?
Yeah, it hasn't materially impacted our business. We have a quiet, sustainable, low-cost aircraft. It's not really the target of anything that kind of comes across the wire. The government shutdown impacted the way in which we did the IPO process, which we were on the road for a long time, 20 days. And what was fascinating to me is that the more investors dug into our business on meeting 1, 2, and 3 and got deep into the technical, the certification strategy, and the production strategy, the bigger their orders got. not the other way around. And we ended up so oversubscribed, and it kept coming that we met with somebody once, they put an order in. The next meeting, they put a bigger order in. And the next meeting, they put a bigger order in, which was, I think, a testament to the quality of the engineering and the team behind this company.
Kyle Clark, CEO and founder of Beta Technologies, IPOing here at the stock exchange today, priced at $34 a share. I don't think we have an indication yet, but it's good to have you here at Post 9. Thank you.
Appreciate it.
Good to see you, Morgan. Thanks for coming in. Morgan Brennan. Let's get a CNBC News update with Courtney Reagan. Hey, Court.
Hi, Carl. Tributes are pouring in for the late former Vice President Dick Cheney, the staunch conservative who led the charge for the invasion of Iraq and served in 3 Republican administrations. Former President George W. Bush released a statement this morning calling his VP a calm and steady presence in the White House amid great national challenges. Cheney's family says he died yesterday of complications from pneumonia and cardiovascular disease. He was 84 years old. Officials in Rome say the worker trapped for hours under the rubble of a partially collapsed medieval tower has died. Rescuers worked for 11 hours to pull him out of the wreckage. The 13th century tower was being restored to be turned into a museum and conference space. And Kimberly Guilfoyle, the Trump ally and former Fox News host, officially took office today as the first female U.S. ambassador to Greece. She presented her diplomatic credentials to Greece's president today. She assumes the office just before the U.S. is set to hold talks in Athens this week on expanding Western gas exports to Ukraine. Carl, back to you.
All right, Courtney, thank you. When we come back, is AI being used as a mask to cover up the real reason for large-scale layoffs? We're going to tell you about a new trend that some are calling AI washing. Later on, Ted Leonsis, CEO of Monumental Sports and Entertainment, is with us, owner of teams like the NBA's Washington Wizards, hockey's Capitals. And check out some of the action in Bitcoin as we go to break lower again today, getting close to 104, 103. That's about a 4.5-month low. Stay with us.
Welcome back. Advances in artificial intelligence have certainly been blamed a bit for a host of corporate layoffs that we've seen recently. But are companies using the technology perhaps as an excuse that are covering up other weaknesses? Steve Leisman has that story for us. Steve.
David, yeah, 48,000 layoffs at UPS, 14,000 at Amazon, 1,800 at Target. A slew of layoffs have raised fears that AI is already whacking corporate jobs. But not so fast. In some cases, companies could be involved in AI washing, attributing job loss to AI when, in fact, it could be a downturn in the business or a simple restructuring. UPS saying in its earnings, quote, "We launched our efficiency reimagined initiatives to undertake the end-to-end process redesigned effort, which will align our organizational processes to the network reconfiguration," whatever that means. My colleague Frank Holland found there was some AI-related job losses, but 34,000 were linked largely to closing buildings, right-sizing the staff levels, particularly in the wake of the online shopping boom from the pandemic. Amazon CEO Andy Jassy had to walk back the impression created by the media and the company itself that recent layoffs were linked to AI. The layoffs, he said, were, quote, "not really financially driven, and it's not really even AI-driven. Not right now, it's culture." Peter Capelli, a professor of management at the Wharton School, says there's little evidence so far that companies are even able to replace workers now at scale.
Using AI and introducing it to save jobs turns out to be an enormously complicated and time-consuming exercise. I think there's still a perception that it's simple and easy and cheap to do, and it's really not.
What we've seen so far, AI taking low-skilled jobs, entry-level, some communications jobs, some white-collar workers, but not in large numbers. These are just early days for the new technology responsible for mass layoffs. It could be coming, but investors should be wary of regular old job cuts wrapped in AI clothing. Guys?
In other words, it's an excuse.
It may be, but I mean, Steve, you do have CEOs, Doug McMillon, for example, at Walmart, who's been talking about this a lot lately, kind of indicating we're going to have to, retrain for so many different jobs in terms of what they're going to be. We just don't know, really, is the answer, what's coming at this point.
No, and it's not really to take away from the idea that it is coming. It's just that right now it seems, David, think about 14,000 bespoke white-collar jobs at a particular place. The thing about technology is it still has to be a commodity that it's replacing, right? So is the job that this person does over here and that person, is AI ready to replace all that? And does all that happen without anybody really knowing it? The point here is not that it's not coming, but it's to be skeptical when companies say it's already here.
The other argument I've heard last couple of days, Steve, has been, post-COVID hoarding, right, where you weren't sure how big your pool of candidate would be if you did not fill a position or if you let someone go. That's obviously changed. I also thought Cook's comments yesterday were interesting regarding the potential negative impact of AI on labor.
I think that's certainly something that I know the Fed is talking about and bracing for. But, when a company like UPS says something like, we've launched our efficiency reimagined initiatives to make the processes to the network reconfiguration, what does any of that stuff even mean? When you come, I mean, that's just a special piece of the use of the English language right there. But look, here's the thing. It is definitely going to be some job losses. But even Goldman, which did a take on, say, 4% this year, maybe 11% over 3 years, there's also going to be jobs created. I'm not saying we shouldn't be afraid of it. I'm also saying it's not coming. It's just right now, it looks like early days to be saying we laid off 30,000 people for AI.
Mike Arrighetti was talking about this yesterday. He was saying it's less in the layoffs and more in the lack of new hiring.
Right.
Because
And
they're trying to figure that out.
we've been saying this a lot, Steve, that it's not necessarily AI related specifically in terms of these layoffs, but much more what Sarah just indicated in the conversations we've been having at the desk as well with certain of our guests.
I think,
Sarah, it's what's coming in terms of will it keep a lid on new hiring? By the way, that press release you referenced may well have been written by ChatGPT.
It sounds like it. I think Sarah's got it right. What I think people are doing is this cautious approach of we can't go in and replace those workers, but let's not bring anybody else on before we can figure out how AI does it. The other thing is that let's not confuse automation with AI. We've been automating for, I don't know, thousands of years, certainly more intensely in the last 300. To come along and it automates, that doesn't mean it's AI. One more thing I think is out there, which is that there's so much enthusiasm around the stocks, around the investment. People are very hungry for the results. And it's very hard to see those results, at least now. And people really want to see the results to justify the investment on the other end. So there's maybe some over-exuberance or over-enthusiasm here in trying to see and really attribute AI to certain results at this point.
Watch for the words productivity and efficiency, I guess.
Sure.
Steve, thanks.
Thanks.
With a deep dive there into AI impact on the labor market. CEO of Monumental Sports and Entertainment coming up with us after the break. The owner of teams like the NBA's Washington Wizards and the NHL's Capitals. The NHL just inking agreements with prediction markets, Kalshi and Polymarket. That's something to discuss. And then next hour, don't miss a rare sit-down with the CEO of Aramco from Aramco's headquarters in Saudi Arabia. His outlook for the energy market and much more. Stay with us. Traders have been paying a lot of attention to things like big tech and crypto lately, but we're going to hear from one expert who's making the case for small caps. He'll explain why he thinks they're a compelling buy right now. Don't miss our Market Navigator segment today on Power Lunch. That's 2 p.m. Eastern. Welcome back to Squawk on the Street. Fox announcing that Game 7 of the World Series between the Toronto Blue Jays and the Los Angeles Dodgers brought in nearly 26 million viewers across its platforms, making it the most watched World Series game since 2017. It's a reminder that sports continues to drive viewership in the TV business. The NBA also recently announcing its opening week was its most watched in 8 years. Our next guest owns teams across the NBA, WNBA, and NHL, and is a sports business veteran. Joining us here first on CNBC is Monumental Sports and Entertainment CEO Ted Leonsis. Ted, welcome to Post Live.
Thank you, and really all the buzz, though, right on the floor here is you just had a huge IPO, electric planes.
Yes,
and
we just spoke to him.
little known fact that the founder CEO was a hockey player at Harvard and was drafted by the Washington Capitals. How's that? So I don't
and
know.
instead founded a electric
Instead,
plane
yeah, he
company.
could have had a career as maybe a third
That's
and fourth
synergy
line.
right
That's
here.
synergy.
Yeah.
Who knew, right?
Amazing. So you had a little reunion. Look, I just wanted on the World Series ratings, clearly very strong. Any lessons, any takeaways for your leagues?
Yeah, I think something very subtle happened there. The owner of the Dodgers was approved to buy the remainder and 100% of the Lakers. And so now in LA, there'll be a baseball team and a basketball team all under one ownership umbrella. Toronto is a great series. They're Rogers Communications, and Rogers will end up buying 100% of the hockey team and the basketball team, and they have the baseball team. And I think what you're seeing is big platform companies run like they're big tech media companies are really stepping to the fore. And they do it for the benefit of the fans, right? The more revenues that they're generating, the more they can invest in their payroll. And that was one of the most exciting World Series I'd ever been able to watch.
And that's what you're trying to do. I mean, this is your platform at Monumental.
And I think it'll be very on trend, especially in big markets. You have to have outside investors. We've brought in sovereign wealth funds. We have the Qataris, QIA. It's one of our investors. You have to be in the multiple revenue stream business. You're in the real estate business with the venue. You're in the IP business with the teams. You're in the distribution business. We own our network. Rogers owns the network. They own the teams. They own the buildings. I think you'll see a real bringing together of these platform companies.
It's like a conglomerate.
Yeah.
Why is that better? Why is it better when it comes to leveraging tech and AI, which I know is obviously core to what you're doing and your background?
Yeah, I think we've been misunderstood as an industry. We look very much like a SaaS business. We have reoccurring revenues, subscriptions, even our season tickets are, subscription-based, our suites, our naming rights, and they built in escalators, so it's very predictable business. There's very little downside to it. But we are, unlike a software business, kind of AI proof. We're not threatened by AI. In fact, we're building AI and we become a launch pad for a lot of these new technologies. And I'm sure at some point there'll be some video games that will take advantage of these AI platforms. Was LeBron's Lakers team as good as LeBron's Cavaliers team? And bring through the video and let's show the games and then let me bet on the games. And so I do think AI will enhance the experience, but you got to come to the game. You have to convene the game. The people that were at that World Series game, the ratings you saw were off the chart. There's nothing like bringing people together in a winning sports team that brings a community together and makes their level of engagement super valuable, and that's why these teams are being valued so highly. Lakers at $10 billion. I'm sure the Dodgers are a global franchise now. They have to be at $10 billion. These become really important businesses, growth businesses.
Yeah, I mean, one question we've been asking, besides are we in an AI bubble, is there a sport valuation bubble, or is the sky the limit?
I think the teams are undervalued. We still have... there's only one hockey team, only one basketball team in our 10 million person market. And the predictability of our revenues, I mean, the Capitals are considered a new team. We had our 50th anniversary last year. And the leagues are now really growth mindset on digital and global. You look at the NBA, there's 1 billion people on the planet that say they love basketball. We have NBA China, we have NBA Africa, we're now looking at
NBA Europe, right? Yeah, Tony Parker and I know all that, yeah.
And those are real strong growth vectors, not unlike an Amazon, not unlike a Google. Google has 14 brands that have 1 billion users each. United States, North America, 300 million users. The rest of the world, 8 billion people. So it's got to be global and it's got to be digital.
I remember years ago profiling Marbury in Beijing, and it was so obvious how crazy that population is for basketball. Does it run into trade friction? Has it been like nothing ever happened?
Right now, it's like nothing ever happened. In fact, Steph was at the Wizards-Knicks game last night in MSG. I remember bringing a sneaker there, low price sneakers. And China's a huge market, not only for CCTV, but we do a lot of work with Tencent. Esports is really important to them. And just the notion of competition, and there being rules, and there being officials, and there being kind of a time-honored way of how you monetize it through the consumer, through the media partnerships, through merchandising. And so the global phenomenon, as I said, if 1 billion people like basketball, what about the other 7 billion? That's our TAM, right? That's what we have to look at. And so that's why these businesses are, I think, undervalued.
So, Ted, since you own a bunch of the Washington teams, I'm curious, the government shutdown now, stretching into a record time, is that impacting consumers?
I'm sure it will, but what we try to do is be socially responsible, and we're hosting 500 at every game, giving them.
It's not hitting ticket sales yet?
It hasn't yet, but it could in the out if this continued. But we want to give back to these people. We've been hosting FBI, we've been hosting first responders, we've been hosting the flight people, bring them to games, take their mind off of things, feed them some food, let them enjoy some time.
Well, we appreciate you coming on, telling us a little bit about the business and the updates. Ted Leonsis, great to see you.
Great to see you.
From Monumental Sports.
After the break, the bidding war for weight loss drug developer Metsera heats up with upsized bids from Novo and Pfizer. Faber's been all over it. We'll get to it after the break.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
We got an old-fashioned bidding war going on between Novo Nordisk and Pfizer to take control of Metsera. Our viewers may remember it was last week, or actually a few weeks ago, Pfizer had a deal to acquire this company to try to build its presence in the GLP-1 arena, essentially, reducing, obviously, people's weight, where it really has not had a great deal of success going up against the incumbents, Eli Lilly and Novo Nordisk. But then Novo came in last week with an interesting offer in terms of its structure that would pay shareholders of Metsera immediately upon the signing of a transaction, a very large amount, actually all of the consideration. It would then acquire the company at a later date once it had received antitrust approval. Pfizer objecting to that, suing. In fact, there is a hearing for a temporary restraining order that begins 6 minutes from now on that. But prior to that, Pfizer still decided, well, we better raise our bid. And so they did, to $60 a share and then $10 in a contingent value right. These are these things we often see in these kinds of deals that are contingent upon reaching certain milestones for drugs that are yet to be approved or in the pipeline and things of that nature. Novo came right back, though, and goes to $86.20 total value, where they're paying $62.20. That, again, is the amount you would get immediately, and then it would be paid as a dividend to shareholders by Metsera, and a CVR of $24. That has now been deemed superior. Pfizer is yet again on the clock, which is set at, I believe it was 4 days from when they have deemed Novo superior. And meanwhile, we'll see what the judge has to say for this TRO, although Pfizer may have undermined some of its arguments by deciding to raise its bid in the way that it did. Of course, all of this underlines the importance of the product portfolio at this company and the importance overall of the GLP-1 class of drugs, the value of which has largely accrued to the two leaders, namely Novo and Lilly. For its part, Albert Bourla on the call for Pfizer, which had earnings this morning, had this to say about Novo's bid.
I want to address our proposed acquisition of Metsera. We believe that Novo Nordisk's offer is illusory and cannot constitute superior proposal under the terms of our merger agreement with Metsera because it violates antitrust law and there is a high risk it will never be consummated.
Of course, best case scenario would be they actually get blocked, you get paid, and then they go out and sell themselves to Pfizer at a later date. Carl?
David, appreciate that. We talked a bit about Pfizer's earnings results as well and their guidance, raising guidance for the second quarter in a row. When we come back, a rare interview with the CEO of Aramco coming up next as Money Movers begins in just a few minutes. Good Tuesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen, live at Post 9 at the New York Stock Exchange. Today, big banks warning of a looming market correction, but we're joined by RBC's head of equity strategy to explain why she's not so worried about a major drawdown.
Plus, despite oil prices remaining under pressure, the world's largest oil company, that is Aramco, beating quarterly expectations on the back of higher production. An exclusive interview with the CEO, Amin Nasser, where we talk oil demand, growth opportunities, the impact of EVs, and much more.
Uber shares under some pressure, close to the bottom of a multi-month range. What the company's results today say about the state of the autonomous driving race.
Right now in the markets, we got a dip at the open. Looks like it had been bought. We're down about 0.6% on the S&P 500. You do have a few sectors green. Financials holding up. They're the top of the market right now. Real estate, staples, and healthcare. So the rest of it is just the defensive groups. Everybody else is down. Tech is pulling back, and the Nasdaq Composite is down a little bit more than 1%. Some earnings in focus, but pullbacks for NVIDIA, Palantir off earnings, Tesla, Microsoft, and Alphabet. For more on the markets, we are joined here at Post 9 by RBC Capital Markets head of U.S. equity strategy, Lori Calvasina. I mean, some of the reasons cited today, valuation concerns, earnings that aren't coming in as perfectly as the market is set up. Anything concerning to you?
So, look, we've had a short-term cautious view. We've been constructive on the year ahead, and we've said be wary of a 5 to 10% type drawdown, and frankly, that could be closer to 5 than 10. But I think we've had sort of this short-term cautious view, and we have been worried about things like valuations, peaking earnings revisions. But we have a framework where when we think about pullbacks, we think about how far they can go, and we're not in the recession camp. So we're not looking for anything nasty like what we had back in April. We do think you need to have a bit of a pause that refreshes. I have been waiting for that for quite some time. We'll see if it's starting now. But I do think there is something to the idea that valuations have been hitting a ceiling since August, and we just can't seem to break through if you're looking at S&P top 10, NASDAQ 100, S&P cap weighted. And even if you look outside the top 10 names in the S&P 500, the rest of the market is pretty close to its typical highs as well. So I do think that we've got a bit of sticker shock in the market at the moment we've got to work through.
Yeah, I mean, I wonder if you look at things like Bitcoin, for instance, as leading indicators, which is really starting to see some pronounced weakness.
We have, and I'll tell you, it has been showing this kind of choppiness. I'm struggling to find the right word for it, but it kind of lurches, right? It lurches down, and then you think you're getting the correction, and it does tend to correlate pretty well with the S&P 500. We've often been told that this is a great way to track sort of retail investor, sort of sentiment out there. And frankly, we've seen that a number of times as well over the last few months where we get this pullback in Bitcoin. We think it's going to pull through to the S&P, and it feels like it's starting, and then it lurches back.
You've been pretty neutral on small caps,
yes,
right? Is that a reflection of your house view on what the economy is going to do next year?
So I think it's part of it. At RBC, we tend to have a free marketplace of ideas. We all talk to each other, but we don't force agreement. I do think we end up on the same page a lot of the time, and our economist is calling, for I think 1.6% next year. I think they're at 1.8 this year. So kind of consistently in that 1 to 2% range, and that's a fine economy, but it's not a hot economy. If you want to see longer-term small cap outperformance sustained, you got to have more than rate cuts. You need to either break the economy and buy the rebound, or see things like ISM manufacturing moving up, jobs growth accelerating. That's just not the environment we're in, and the hedge funds tend to rent the small caps for a little while when they get optimistic on Fed cuts. Then once they get past that, they sell, they get out of them, and there's not really anyone, because you don't have that hot economic backdrop, there's not really anyone else to pick them up.
Then the Fed chair says far from it, and some of the other Fed speakers this week say not too committal on December.
Right, and even if you looked at, we like to watch Russell 2000 against S&P 500 as well as the NASDAQ 100. If you look at it against the NASDAQ 100, you've basically given up all the post-Jackson Hole outperformance, and if you look at it against S&P 500, you peaked in mid-October, even before Powell spooked the market on rates.
So what about the S&P 500 takeaways from earnings season so far? Yes, it was a high bar, but it feels pretty positive overall.
So this is the best stat to look at. Everybody looks at beat rates. Those are coming in really well. But we like to look at the rate of upward revisions. We view that as earnings sentiment. Other people will refer to that as earnings breadth. But we think it's a good way to just track, are people pulling the numbers up and down, and at what rate? That stat hit 28% in April. That's a typical non-crisis low. It then rebounded to about 66% in mid-August. That's a typical high if you're not rebounding off, say, something like the COVID recession, right? Kind of a typical high outside of a major crisis recovery. And now we've fallen back down. We're not negative. We had gotten as low as 51.9% a couple weeks ago, so just basically, barely in upward revision territory. That stat has fought back to 55% in our latest update, so it's improved a little bit. But what's really interesting, Sarah, is that if you look at the top 10 market cap names, the AI names, they hit a major peak and they're still decelerating. They're still positive, but they didn't show any stabilization in the last week. We don't have the numbers yet for this week and kind of post that big tranche of Mag 7 that came out late last week, so we'll see where it is. But generally, you have weakening earnings sentiment, and it is weakening for these AI names.
But strengthening for the rest of the market. It's not as much as it was.
It strengthened a little bit, and we have to see if that's noise, because if I go and look at the commentary, so we read tons of earnings calls. We read, frankly, as many as we can get through. I think there were 162 last week, so I'm not going to lie, we didn't read energy and utilities. But we have a small team. But,
AI will read it all eventually.
Eventually. But look, they don't say that much that's helpful to us on the macro, to be honest, outside of maybe Utes on data centers. But the reality is that the tech companies, if you think about like the users versus the builders of the AI technology all sounded great. The users are still doing what I'm calling small potatoes examples. I wouldn't use the word transformational to describe this technology right now. I think they're having impacts, and companies are doing a better job of articulating them. But they're not transforming anything here and now, at least what I'm hearing, from kind of, your typical consumer or healthcare company.
It is interesting. I was watching Caterpillar today, which has an analyst day today. Yeah. They raised their 5-year revenue CAGR. Stock's down 3%. I mean, this was turning into a pretty nice AI development shovel play.
But what I'll tell you with the industrial sector, we look at weighted PEs on a forward basis for all the different sectors in the S&P 500. So just, a median, not a weighted. And what we're seeing for the industrial sector is the Z-score is the highest of any sector on both an absolute and relative basis. So the industrial sector is even more expensive than the tech sector broadly if you just look at median PEs.
Okay, Lori, well, thank you for joining us. I feel like you're painting overall like a bit of a cautious picture, right?
We've got some stuff to work through. I don't think it's going to be a disaster. We need that drawdown. I'm frankly surprised we haven't had it yet. The industrials have been kind of balanced. I thought we would have heard, sort of more tariff impacts than what we've gotten. Instead, we've gotten some spookiness on the AI story. The consumer companies, we didn't have a chance to get into those, but they sounded lousy.
Consumer staples, for sure.
Yeah. Even some of the discretionary companies as well.
All right, Lori Calvasina, RBC Capital Markets. Thank you.
Meantime, that government shutdown, as you might know, now in day 34, is tying for the longest shutdown in history. Our Emily Wilkins has some details on maybe some off-ramps. Emily, good morning.
Good morning, Carl. And remember, this shutdown is a full shutdown. The last one was only a partial shutdown. So really a big impact this time, and we're already seeing some of that pressure. The Senate here is about to start voting for the 14th time on that stopgap that would reopen the government, but only until November 21st. That's what they've been voting on all this time. And you actually heard Senate Majority Leader John Thune say yesterday that they are going to have to, when they actually have the votes, roll that back, that they can't do it until November 21st. That doesn't give them enough time to get together those bills to really fund the government for fiscal year 2026. And you just heard Speaker Mike Johnson say that if they were going to pull out the deadline, it would need to go past December, probably sometime into January. So that's one sign of movement here. Thune is saying that he does expect, is at least more optimistic that there could be an off-ramp this week. We have seen bipartisan talks among senators ramp up. We're hearing some discussions about maybe combining a promised vote on those Affordable Care Act tax credits for premiums, along with some of the funding bills for fiscal year 2026. But at this point, nothing is set in stone. It's not clear that they have a deal, and it's not clear even exactly when this shutdown is going to end. Of course, another thing we're keeping an eye on today, it is Election Day in Virginia and New Jersey for their governor races. Both of those, the Democrat is expected to win based on the polling, but New Jersey is incredibly tight. And if there is an unexpected wave one way or the other, that's going to require the parties to rethink their strategy. Part of the reason the shutdown has gone on so long is that everyone has been relatively comfortable holding their position. But if the polls deliver a surprise tonight, that could very quickly change. Guys?
Emily, I've got to get your take on the filibuster bypass, why the president's rhetoric has gotten even sharper, and why Speaker Johnson appears to be resolute in saying this could be dangerous once the shoe's on the other foot.
I mean, it's Speaker Johnson, it's Majority Leader Thune, it's almost every Republican who I've talked to here, at least on the Senate side. And it's because, Carl, as you mentioned, if they get rid of the filibuster now, that means that it's not there when Democrats eventually take back the Senate. I mean, you've seen the pendulum swing back and forth between Republican control and Democratic control. A lot of senators recognize the importance of the filibuster. Plus, it seems like if a deal is coming together, that could be a potential path out, and they wouldn't need to go down the path of abolishing the filibuster.
Right, but he's made the point, the president, that they're risking the midterms by not doing this, what he calls nuclear option. I guess it depends if that picks up any traction. Doesn't look like it in the Republican Party yet. Thank you, Emily Wilkins.
When we come back this morning, CEO of the Williams is going to join us on the company's latest quarter. Look for nat gas, as we know, has been a bit of a tear. Stocks heading lower on the heels of that report.
And later, a closer look at two big earnings movers this morning, Uber and Norwegian Cruise Line. What those CEOs are saying about the latest quarterly results and demand. Money Movers will be right back.
Order filled.
Welcome back. Take a look at shares of Williams today. The company handles roughly a third of all nat gas in this country, 33,000 miles of pipelines. Lower today despite reporting a beat on the top and the bottom line in Q3, pointing to unprecedented growth in power demand from both AI and data centers. And joining us first this morning in his first on CNBC interview is Williams CEO Chad Zamarin. Chad, appreciate it as always. Good to see you.
Hey, good to see you, Carl.
We kind of got this short-term inventory cycle and winter coming story, but the longer-term AI development, what kind of story are you trying to frame for investors?
Yeah, you know, it's a really exciting time for our company and frankly for our country. And Natural gas is the enabler for our economy. If you think about coming into this winter, we're fairly well balanced from a natural gas perspective, but the cost to produce natural gas in the United States on an energy equivalent basis, if you thought about the cost of a gallon of gasoline, it's the equivalent of 50 cents per gallon gasoline. Like, natural gas is America's affordability superpower. And so when we think about powering our economy, when we think about powering this next generation of technology and artificial intelligence, we have the most affordable energy available. It also is the most dispatchable and fastest speed to market capability that we have at scale. And so we see an incredible opportunity for natural gas to be the key to unlocking our nation's full potential, both from an overall economy perspective, but also from an AI and technology perspective.
When you think about investor interest, and I guess by that I mean price action in other forms of energy that will take much longer to come to market, are you surprised given the lag?
Yeah, we've had a great run, and I think there is an expectation and a recognition that natural gas infrastructure is going to be our nation's key enabler for the near term and, frankly, likely for the mid and even longer term. We're always going to need to explore new technologies to bring more energy to our country. I mean, if you look at our country over the last 25 years, we haven't grown electricity production virtually at all for 25 years. And so we've got to get back to building infrastructure and energy production at a scale that we haven't for over 2 decades. And so when we think about how we're going to grow our economy, how we're going to deliver this next generation technology, we know that natural gas can scale fast. We know that it is our affordability superpower. And we also know that it can meet the customer when and where the needs are. So we're going to need to lean on that capability that we have while we continue to explore additional technologies. Frankly, we're going to need an all-the-above approach. But natural gas is going to be that superpower for the here and now.
I mean, it's something that this administration is leaning into in a big way, and the president campaigned on it. Are you actually seeing approvals speed up? Has there been a change?
We're hopeful. I do think that, the administration has raised their voice on these issues. I think, frankly, our country is seeing the affordability challenge come, front and center. And as I mentioned, if you look across the country, markets that have managed price and affordability well, frankly, it begins with energy, and that's primarily where we've been able to lean into the low-cost natural gas that we produce here in the United States. Give you a contrast, in the New England states, we see natural gas prices that on average are more than 3 times the national average, and during the winter times, oftentimes 30 times the cost of gas in other parts of the country. That's not because we don't have abundant available natural gas. It's because we don't have infrastructure that delivers that energy into those markets. And so we are seeing hopeful signs that governors and, frankly, the public at large recognize the need for a more rational approach to energy. And so, we've got 2 projects in New York. It's been over a decade. Silly in other parts of the country are gonna make it.
Are you saying that lack of infrastructure is due to governments, not red tape, that sort of thing?
Yeah, absolutely. What we've seen in the pipeline industry in order to bring natural gas into new markets is there are certain authorities that states have that they can use to effectively weaponize the permitting process. And, I think that unfortunately we had some policy that maybe didn't understand how complex energy systems are, that you can't just entirely replace one system with another system and not have unintended consequences. And so, I think we're seeing people better understand the complexity of this market. But yeah, we've seen states that have weaponized the permitting process and created regulatory burdens that have made it hard to build infrastructure, which is why you're seeing development in only certain parts of our country. And frankly, that's not good for our country. We need to be able to build infrastructure across the United States, and it's become increasingly difficult to do so. But I think there are hopeful signs that we'll get back to building.
It's obviously not the consensus view, but the street is trying to think about what would happen if cloud adoption, or certainly AI cloud adoption, data center development, hyperscale CapEx, all took a second derivative turn lower or whatever. How do you explain to investors how these resources would be allocated in a scenario like that?
Yeah, for us, we're very focused on making sure that as a country, we have the infrastructure and energy available to reach full potential. So we're spending time with the hyperscalers that have direct end-use needs. And, I saw your previous guest. We've got some very exciting and compelling use cases for artificial intelligence. And we're just scratching the surface of what we could do to modernize our company, to modernize our industries, and become more efficient at moving energy, as a great example. And so we've got a lot of hope that the AI solutions will come to full potential. But importantly, we're spending time with the hyperscalers. We are bringing speed to market solutions. We've got several projects where we're going to build pipeline infrastructure, generation infrastructure, so that we can power data centers, not in 3 to 5 years, but in the next 12 to 18 months, while we also expand infrastructure to build out the grid over time.
Yeah, that's a huge part of the puzzle, is that co-location and riding the growth as it happens. Chad, really interesting. We're in the middle of it now, that's for sure. It's good to talk to you. Thank you.
Thanks, Carl. Good to talk to you.
And much more on the energy space is coming up, especially on this gas story. Our exclusive interview with the CEO of Aramco, the world's largest oil company, and why he is upping his forecast today on gas production. We also discuss the demand overall from the world right now for oil, his strategy, and more.
Also, shares of Uber, we mentioned earlier, falling this morning on this lower than expected EBITDA forecast. We will take a closer look at their quarter as soon as we come back.
Order filled.
Shares of Uber tanking today after posting strong profits and revenue, but lower than expected EBITDA forecast. The quarter also a read on how the autonomous race is evolving. Our Mackenzie Sagalos has more in today's Tech Check segment. Hi, Mac. Hey, Sarah. So Uber's latest results showing its strongest top-line growth in nearly 3 years and its largest trip volume increase in its history outside the post-COVID rebound. But the stock, you said it is in sell-off mode as investors focus on a softer outlook. Now, while trips and bookings were both up more than 20% with mobility and delivery accelerating, the street zeroed in on Uber's underwhelming Q4 guide, with Jefferies calling it a bit of a knife fight in rideshare and noting little upside to pull in the bears. But Uber is leaning into what driverless can deliver, with CEO Dara Khosrowshahi touting the company's new partnership with NVIDIA on this morning's earnings call, saying that if there is one ally that you want in AI, it's them. Now, the two companies plan to build 100,000 nearly driverless vehicles together, a clear bet on a future beyond human drivers. Khosrowshahi also calling autonomy central to long-term growth, predicting that within a decade, every new car sold will be self-driving ready.
So it absolutely is happening now, but at very small scale. While autonomous is something that a lot of people are experiencing, it's a terrific product. We think it releases another $1 trillion opportunity for us. At this point, it is not at scale.
Now, early signs are promising. Waymo-powered markets like Austin and Atlanta, where Uber runs its AV service, are growing more than twice as fast as the rest of the U.S., with drivers earning more in those cities than the national average. Uber says it's too soon to call the correlation causal, but that the hybrid model of humans and robots does appear to be working. Guys?
Meantime, their gross bookings guidance for the quarter for Q4, Mac, kind of in line, although we were asking earlier this morning why that would result in the price action that we're getting today.
Right. You know, something that I've actually been looking at with respect to their monthly active users and also the number of drivers, the number of weekly drives that they're booking. If you're looking at it on a weekly basis, it's 292 million. You've got Waymo that by the end of next year is looking at 1 million trips per week. So you're still seeing a pretty bullish move in its core business versus the driverless side of its business. But yeah, it's really that soft core Q4 guide that's seeming to weigh down investor sentiment right now.
Yeah, it's been in this $10 range, more or less, between 90 and 100, going back to, say, mid-June, and currently trying to ride the bottom of that channel. Mac, thanks.
When we come back, CEO of FedEx making some comments on China policy and the impact of tariffs. We'll bring you those conversation highlights next. The stock down roughly 10% this year. We're back in a moment.
Order filled. Order filled. Order filled. Order filled. Order filled.
The CEO of FedEx speaking to Arsima Modi on U.S.-China policy and his expectations for tariffs. Arsima joins us this morning with those comments. Hey, Seema.
Hey, Carl. In addition to being the CEO of FedEx, Raj Subramaniam also chairs the U.S.-China Business Council, and he shared with me last night at an Asia Society Pratham event that he's encouraged by the latest trade de-escalation and thinks that a meeting between President Trump and President Xi that may take place next spring sets a table for more progress.
Hopefully that's the floor that's been drawn, and then the announcement of a potential bilateral meeting in Beijing in the spring is helpful. And hopefully then we move forward from here. I think it's, I think a lot of, especially the businesses, are looking for some kind of clarity on where things stand. And I think these communications and these meetings will actually provide more of those clarities.
Now, China is FedEx's second largest market, and like so many companies, FedEx too is being hit by tariffs. But Subramaniam thinks the trade narrative will improve. He doesn't see it getting worse.
I think it's a floor. I think, you know, I think there's some, again, like I said, as we get more certainty, then businesses can plan better. That's what I expect. I don't think it's not going to go back to where it was, and that's not going to happen.
Now, on artificial intelligence, he detailed how the transportation company is embedding AI with a new ServiceNow partnership that will help consolidate its data and speed up procurement. He didn't see AI fueling job cuts, but that was clearly a technology that every company is trying to figure out how it helps them speed up deliveries, guys.
I'm just looking at the stock, Seema. It's down, you know, over the last year or so. Hasn't done a whole lot. What is it tied to the FedEx performance, or is it the manufacturing rebound that everyone's waiting for? Trade?
Yeah, you know, probably a couple different things here. Macro environment, the industrial production volumes have also been a little slow across the industry. Listen, this company is in the midst of a big transformation. They're merging two businesses, spinning off freight sometime next year. So this is sort of just a broader story that is in the works there. And Subramaniam, the second CEO to lead FedEx. So they're really in it right now, trying to innovate, but also trying to capitalize on all these growing trends like data center build-outs, guys.
Okay, Seema, thank you. He was in Saudi Arabia last week talking about the first flight that they actually had take off from Riyadh when it comes to shipping. They see a big market there. After the break, we'll bring you an exclusive interview, speaking of Saudi, with Aramco, the world's largest oil company. We discussed the outlook for demand from China, how the company is diversifying its business, and much more. Money Movers will be right back.
Order filled. Order filled. Order filled. Order filled.
Saudi Aramco reporting third quarter earnings today. Profit rising from last quarter, though down year over year. The company increasing its gas production growth target. That was news, to 80% above its 2021 level. It had previously been targeting 60%. I sat down with the CEO of the world's largest oil company, Aramco, Amin Nasser, last week while I was in Saudi Arabia at their headquarters in Dhahran. We talked about how the company is looking to diversify its business and the outlook for oil demand overall. Listen.
We strongly believe that the demand fundamental is healthy and strong. We are seeing a demand growth of about 1.1 to 1.3 million barrels per day this year, almost the same next year in 2026. It's a record year for oil, gas, and even coal. When you look at the 5-year average, it's at the lowest end of the 5-year average in terms of physical barrels storage available in the market.
Order
so it
filled.
tells you that demand is real and it is strong. It is see this storage facility increasing significantly.
We don't have oversupply glut because supply is growing from the U.S.
Supply-demand fundamentals is healthy. We are seeing more demand, especially from developing countries. We're seeing demand growth from Asia in general, and even from the U.S. The demand is strong, and that's reflected on the call on us for supply.
There's a concern about China demand, that they're shifting to EVs quite rapidly, and that'll decrease their oil consumption. They've been the biggest consumer for years now.
True, there is an increase in the number of electric vehicles in China, but you have to look at also the other sectors, because even with that growth in electric vehicles, and still internal combustion fleet is huge in China, the other sectors that are also increasing, offsetting that small decrease in because of electric vehicles, is aviation is growing by almost 8 to 9% in China, requiring more jet fuels, and liquid to chemical. We are seeing growth of 500 to 700,000 to supply carbon fiber for electric vehicles, for solar panels, for turbines.
Actually making that.
So they need more liquid to chemical. So oil is shifting to chemicals and using it as carbon fiber on all of these sectors.
So you don't see a slowdown?
No, we don't see. We have been saying this for some time, that oil, gas will continue to grow for decades to come. And this is reflected on record years, year on year.
What about on the supply side? What will be the impact of the U.S. now imposing sanctions on Russian oil companies?
We will wait and see. It gave 30 days for certain companies or certain markets to shift. The sanctions is on Lukoil and Rosneft. We need to understand also Russia supply close to 7 million barrels export to the market, almost 4.5 to 5 million barrels of crude, and to 2.5 million barrels of products, depending on their refining health.
So if there is a need And even if the U.S. goes further here when it comes to Russian oil, would Saudi step in to fill the gap, for instance, to places like India?
Well, you know, with regard to how much we produce every month, targets we receive it from the Ministry of Energy, depending on their agreement and quota based on the OPEC Plus agreement. So that's always will be reviewed by the ministry, and the decisions based on, they always try to stabilize the market and make sure that there is capacity, but this decisions belongs to the Ministry of Energy.
How do tariffs impact the energy market?
Well, you know, oil is not included as part, but tariffs impact the economy, certain economies, and you know, healthier economy means more demand. But we don't see a huge impact as of yet, because the demand this year is healthy, and we expect the demand next year is healthier.
What about your own company's investment? I think you're targeting north of $50 billion in capex this year. Are you on track, and where's that investment going?
Well, you know, the target this year, the guidance is $52 to $58 billion. Today, if you think about Aramco today, there is $100 billion of construction that is going on today. So, but we execute in the neighborhood of $50+ billion in each year in terms of capital. Most of the capital goes to maintaining our capacity, MSC of 12 million barrels, but a lot of the capital is going to gas. We are growing our gas compared by more than 60% by 2030. So gas growth is significant, and most of the capital is going into gas growth, and also our latest partnership with Humane. So we are a big investor in all these sectors, in addition to minerals.
Is that going to include rare earth minerals? Which
we are.
Everyone's interested in?
We are looking at lithium right now, and we're looking at first processing.
In the coming years?
Oh yeah, it is already under. We are drilling, because this comes from aquifers, and we treat this aquifer water, and then we extract lithium.
You've sort of called out others for cutting exploration programs early.
It is important to continue to explore. We've seen what happened in investment now. Oil investment is down compared to higher years by almost 20%. Final investment decision for projects for oil is down by almost 35%. There is a concern, considering that the decline is close to 6 million barrels per day. This is just if you maintain your current production of over 100 million barrels today. The decline, just to maintain that production as is without the growth, is 6 million. Add to it the growth, you need substantial capital investment to meet demand requirements.
So what happened? Everyone just, it was premature to worry about the decline of oil?
Well, I think the forecast had something to do with it. Up to last year, you know, forecasts said that renewable is growing, and, you know, there was some calls for companies to stop investment. If you look at requirement now for data centers, by 2030, the requirement for power for data center is almost 4 times all electric vehicles. So this is substantial. We need more energy because in spite, even though there was almost $11 trillion put in renewables, still renewable created a 15 million barrel of oil equivalent.
It's not going to be enough.
That is totally not enough.
You can catch my full sit down with Amin Nasser right now on CNBC.com. Carl, that's what he's trying to do as the world's largest oil producer, largest exporter, and one of the most valuable companies on the planet, to continue to invest in hydrocarbons, because he's been critical of the industry, you heard right there, for pulling back on cuts because of all these forecasts that have been proven wrong, and also all the worries about ESG and everything else. But at the same time, try to transition the business and invest more in gas, natural gas, in renewables, because they see where this is going. But he says unequivocally there's going to be demand for oil for decades to come. And, you know, it's amazing to go there into their headquarters and just see the scale of the operations. Tomorrow, we're going to take a deeper look at how they're using AI. You know, a lot of companies are saying we're using AI, we're doing data center, we're doing this. So what they have been investing for decades. They have built their own large language model. They have all of these things sort of automated and computerized, and they're using a ton of compute to figure out and also see, they're actually quantifying how much money is being saved and how much money and value is being created by what they're doing on AI right now. So you'll get a good look into that tomorrow. We put it all together in terms of the technology story at Aramco, which I'm not sure is fully appreciated.
Clearly not. I mean, fascinating statistic. We looked at each other just now when he said that stat about how data centers compare to transportation, basically. If they're right, the demand holds up, and if EVs fall as a percent of new car sales every year, I mean, I wonder, are we looking at the bottom of oil prices or near it?
Yeah, right. So he said that powering data centers is going to be 4 times that of all of EVs.
Yes.
Right, and he also made the point when I asked him about the Chinese EVs that actually that they're ramping up oil consumption in so many other places. It also takes a lot of consumption to build EVs. So even if that trend does not go away, neither does the demand for oil and gas and now renewables. And it is fascinating to see how they're sort of balancing all of that and trying to invest around the portfolio.
Right. Look forward to tomorrow. That's good. Yeah. Speaking of fuel consumption, shares of Norwegian Cruise Line are down after missing revenue estimates. We're going to take a closer look at that quarter, what the CEO is saying, as those shares are well negative for the full year. Stay with us. Welcome back. Shares of Norwegian falling this morning on the heels of earnings. Our Contessa Brewer just talked to the CEO and joins us with those comments. Hey, Contessa.
Hey there, Carl. Yeah, the street was just disappointed here with Norwegian lowering its full-year expectations on net yield, or how much it earns on each passenger. And third quarter revenues missed expectations, and yet they were record revenues. Norwegian just boasted its best third quarter ever, best record earnings, and as I said, the record revenue, but you have the shares plummeting in spite of that fact. Okay, let's take a look at the chart. Margin expansion up 600 basis points since the end of 2023, and they're projecting growth over the next few years. I just sat down with Norwegian Cruise Line Holdings CEO Harry Sommer, and I asked him about a growth strategy that puts premium families in focus.
Our occupancy for Q4 is up. We talked about our occupancy next year being at above 2024 and 2023 levels. So we're really seeing those families coming back quite well and quite strongly.
What are you seeing in terms of spend? Do premium families spend more on board? Because, you know, after all, if you're traveling with 4 people rather than 2 and you want the drinks package, well, then that's a drinks package times 4.
Absolutely. Listen, the economics work such that when we can get 3 and 4 people in a cabin, we do better economically than when we only have 2 people in a cabin. So absolutely that works. You know, not necessarily on an average basis because the children are paying a little bit less, but on a per cabin basis, certainly that's better economics for us and better margins and therefore better profitability.
And for those families, a brand new water park opening for the holidays on Norwegian's private destination, Great Stirrup Cay. That is a trend that we're seeing across the cruise industry, these private destinations. Norwegian has 3 cruise lines now. Oceania is luxury, Regent is ultra luxury, and the CEO says both are performing extraordinarily well. Collectively, when you have all these new ships coming online, they'll have 7% more capacity in 2026. But again, right now I'm looking at Norwegian stock down 14.5%. It's very negative for the year, down 25% year to date. But across the board, you're seeing Viking, Royal Caribbean, Carnival well into the red today as well. Guys.
So what's the problem? Because everybody's talking about how the demand is so strong and there's no slowdown happening.
I mean, you're absolutely right to point that out. I think it's just that expectations for the cruise lines are so high. And in fact, I really pressed Harry on that and said, what is it that the street wants to see that you're not delivering? And he said, I just think that post-pandemic, some of our net yields were so high. Remember, like, people were just so eager and chomping at the bit. They'd pay whatever you offered to go on these cruise ships, that even after the pandemic, that the investors still want to see that. So again, even though they set a third quarter record for revenue, it was not enough to satisfy what investors wanted to see. But I think it's really interesting to hear about this focus on families, because I always think of families as being sort of the budget traveler. And he's like, no. We're talking about premium families. These are the families that are going out and spending on excursions. They're going to do the zip lines, which cost extra, anything that costs extra. And you know what you say, okay, I got a great deal on a cruise, and now I'm really going to shell it out.
Yeah, I mean, we talked to Royal Caribbean last week. That was also a sales miss, Contessa, as you know. Vegas has not been on fire by any stretch. Well, there's an item on the wire right now about some layoffs at American. So travel's getting some attention.
Yeah, I think it's still a tale of 2 different segments, where you have the traveler and then the upscale traveler. And upscale, no problem. Interestingly, though, with the government shutdown, that is hitting the lodging sector. The non-essential government travel is out, and it's really starting to hurt the hotel industry, restaurants, and the like that come out of that. But going into 2026, we've heard group business is fully booked. I mean, Las Vegas is very confident that 2026 in the group business will outperform.
Okay, Contessa, thank you. Sure. Valuable to have those comments from the CEO. We've got some developing news here out of the White House regarding the SNAP benefits, food stamps. Eamon Javers with the story. Eamon.
Yeah, Sarah, a striking change in policy here from the White House on SNAP benefits. Just in the past couple of moments, a Truth Social post from President Trump saying that this administration is not going to pay those benefits after all. Here's what the president said. He said SNAP benefits, which increased by billions and billions of dollars many-fold during crooked Joe Biden's disastrous term in office due to the fact that they were haphazardly handed to anyone for the asking, as opposed to just those in need, which is the purpose of SNAP, will be given only when the radical left tough Democrats open up government, which they can easily do and not before. The president changing this administration's policy. It had been the case that the administration was suggesting that they would be able to pay maybe about half of the benefits after a federal judge ordered them to go into an emergency fund in order to do that. We saw Treasury Secretary Bessent out over the weekend saying that they would figure out a way how to legally pay these benefits. And we saw the president last week posting on social media also that he would pay the benefits. Last week, the president said, "I do not want Americans to go hungry just because the radical Democrats refuse to do the right thing and reopen the government. Therefore, I have instructed our lawyers to ask the court to clarify how we can legally fund SNAP as soon as possible." Now the president's saying he is not going to fund SNAP, and White House officials here declining to answer questions about that policy change, simply saying that they refer us back to the Truth Social post. A reminder, guys, about 40 million Americans depend on SNAP benefits for food. About $100 billion a year goes out all told in SNAP. Back over to you.
So, Eamon, are we framing this as a defiance of a court order or not?
That's the question that I asked the White House press shop. Is the president saying he's going to defy the court order here? And they're saying we refer you to the Truth Social post, which doesn't answer that question. So is he going to be in violation of the court's order? That's going to be a matter for the lawyers to decide and for the judge in that case to decide.
How about they just reopen the government and then nobody would have to decide? That would be a novel thing. That would work too.
Yep.
Eamon, we're waiting the Supreme Court hearing on the president's tariffs, the legality of the reciprocal tariffs. Wondering what you're hearing into that.
Yeah, it's so fascinating, right? We saw the president suggesting that he might actually go and attend the Supreme Court arguments. He now says he's not going to do that. Treasury Secretary Bessent saying, though, this morning that he is going to attend the hearing. And that gives you the sense of just how important it is to this White House that they get a favorable ruling here. They've said that about $90 billion in tariff revenue is at stake. They'd have to pay that back, presumably, to the American companies who paid those tariffs if the ruling goes against them at the Supreme Court. So a moment of high drama tomorrow with a little asterisk, which is that the administration has suggested that they have ways to continue to apply tariffs through other mechanisms, even if using this law that they used this year gets struck down as a method to impose tariffs. They say, well, they could reimpose those tariffs or something very similar using some other legal authorities that they have. So it gets complicated, but it's high drama, and the president has said it's one of the most important rulings that this court will ever make.
Thinking a lot about the logistics of having to refund some of those tariffs that have already been paid. Bessent on Squawk this morning saying, in his view, it would be unusual for the court to rule against the president on this front, although I don't usually like to look at betting odds, but odds that the court upholds the emergency tariffs have been falling for the past several weeks.
Yeah, and what the administration is arguing here is that it's that national security and foreign policy piece that should tip the balance, right? The president's been saying this is such an important negotiating tool for me. When I sit down with foreign heads of state, you need to allow me to continue to have this authority. The administration says that deference to the president's role on the global stage should be enough to justify the use of this IEEPA law from 1977 to impose tariffs, even though it hasn't been done that way before, and the law doesn't specifically say tariffs. The opponents, of course, are these plaintiffs in the case who are small business people, not the large global firms, but small business people who've sued here and have said that this is devastating to their business, and this law was not envisioned to be used in this particular way.
Eamon, thanks. Eamon Javers, tomorrow's going to be big as we at least try to keep an eye on the tone sometimes you get in arguments. Gives you an idea where they're headed.
Yeah, I feel like businesses have pretty much accepted the fact, though, that they're going to be paying tariffs one way or the other, but obviously we'll be watching it.
All right. Let's get to Frank Holland in for the judge.
All right, thank you, Sarah and Carl. Welcome to the Halftime Report. I am Frank Holland in for Scott Wapner. Front and center at this hour is the rally. Is it on solid ground or is it on shaky ground? We're seeing some signs of AI exhaustion and much more under the surface. That weakness dragging down stocks today. The investment committee is standing by to break it all down. Joining me for this hour, we do have Josh Brown, Joe Terranova, and Jim Lebenthal. Before we get this conversation started, let's start with a quick check on the markets. You can see we're in the red across the board. The Dow down more than 100 points. The S&P pulling back about 0.75%. The NASDAQ down over 1%. The Russell down just about 0.75%. And that's where we begin. Jim, you're right here at Post 9 with me. At the open, we saw stocks, they kind of moved up from what the levels that we saw in the pre-market. in your mind, what does that symbolize? The fact that we're looking really weak in the pre-market, then we open up. We're still lower, but not as low as we were.
Yeah, I mean, let me not bury the lead here, Frank. It says to me that any dip, no matter how small and inconsequential, is likely to be bought from here to year end. I don't justify that. I don't attach morality to that. I simply make the observation. Market participants with really a minimal amount of experience would have looked at today's futures action when they woke up and said, oh boy, here we go. You know, buckle your seatbelts. And, you know, the S&P 500 opens up, goes down about 1%, and then stabilizes where we are here, down about 0.7%. Now, I have no idea, Frank, how it's going to end up. Could have trail off at the end? Sure, probably. But the simple truth is there is a lot of cash on the sidelines. And the history of the past few months has shown that dips like this are an impetus for money to come in, whether that's retail investors seeing the opportunity, YOLOing, whatever you want to call it, or what I think is the more potent force, it's institutional investors, many of whom, 75% of whom, are behind their benchmarks and look at an opportunity like today as a chance to get in and do a Hail Mary pass to catch up. Look, I don't want to throw caution to the wind by making short-term projections, but I do feel we're seeing that dips are going to be bought from here until year end.
All right. Joe Tenerva, I want to come over to you. Earlier this morning in Hong Kong, we heard from the CEOs of Morgan Stanley, also the CEO of Goldman Sachs, both of them saying we could be on the way for a market correction. Do you think that's what drove some of the action in the pre-market? Is that what's driving the action right now in the regular session?
Breaking news that we potentially could have a correction after having well over 100 trading days without a 5% sustained correction. I think we've all been talking at length over the last several weeks about the possibility as the calendar turns into 2026, you get elevated volatility and you ultimately get a sustained 5% correction. Pick your reasoning. You could cite valuations. You could cite the possibility that maybe AI spend is getting a little uncomfortable place in terms of leverage, or whatever the reason might be. But it's healthy that you get that correction ultimately. I still think the secular tailwinds that are in place, ranging from global central banks who are cutting rates to economic growth that's going to benefit from some fiscal tailwinds and regulatory relief, inflation coming down. I think all those secular tailwinds are still in place. So really, I think what today is about valuation. And I responded yesterday to you when we were talking about Palantir. And my first words were, valuation is the impediment. And I think today, valuation is in the headlines. It's front and center because of a lot of the commentary that we heard from the CEOs. And I think markets are paying heed to valuation, and they're probably rightful to do so. Today, you're seeing healthcare is rallying. You're seeing cryptos coming off. That all makes sense to me if we're going to say, okay, valuations look a little bit extreme. We need to offer some relief there.
Josh, coming over to you. What do you make of today's action? Does this signify a broader trend or a change in momentum or an inflection point, or is it simply just one day?
No, it's more than one day, but I don't look at this as a bad thing. We're actually undergoing a market-wide correction right now. The reason why people don't know it is because it hasn't hit the Mag 7 names, but that's literally what's taking place. I want you to understand, beneath the surface, 31% of the S&P 500's components are more than 20% below 52-week highs. So this rally is not as broad as it was throughout most of the fall, and that's perfectly fine, quite frankly. 6.5% of constituents of the S&P are at 52-week lows today, right now. That's growing. That was probably 4% 2 weeks ago. Median RSI across the entire S&P, 44. That sound like a bull market to you? Me either. The median percentage below 52-week highs is 15%. So what I'm telling you is that the typical stock, not the average, but the typical stock is already in its own correction. 62% of the S&P 500 are below a 50-day. So we do not have this across-the-board rally that we were enjoying for most of September and October. But I want to point out, this is what you want to happen if you want to stay constructive and you want to set up for a year-end run. You've got to see some of the excess come out of the market, and you've got to see companies get sort of sorted out and repriced after running up into their earnings, and that is literally what's taking place. Can I please have a chart of Oracle? This thing just filled the entire gap. So all that good news about they're signing AI deals with Planet Jupiter and Mars and NVIDIA and OpenAI, forget it. Forget it. It's come. I don't know. You guys show me a 5-day chart. I'm trying to show the gap being wiped out. This is what healthy bull markets do. They wick that enthusiasm off the top and reset. And I think it's good. I think this is what you should want if you want to stay constructive here.
Yeah, I mean, I think even to a certain extent, Josh, kind of pointing out your point where you're showing the 1-week chart of Oracle down about 10%. Jimmy, I know you wanted to make one other quick comment, and we're going to move on.
Well, sorry. I mean, I'm an Oracle shareholder, so I'm aware of what Josh is pointing out, and it makes me think that's front of mind for me right now. You know, Oracle is down from 345 after earnings to whatever it is right now. I'm not going to look at the screen, 252, whatever. And whenever you have a downdraft like this, whether it's Oracle, whether it's Meta, there is some reason. I mean, remember NVIDIA going from 160 to 90 in January, and the reason was DeepSeek. But look at where it is now. And my point on this is you have two choices with Oracle. You can either believe OpenAI is going to come through with all of the things that it has announced and promised, or you can believe that it isn't. The answer to that question is not going to be known for probably another 2 years. And in the meantime, what's really weighing on Oracle and on Meta is this debt question of why are they financing things with debt? And I've been saying this for the last week. Frank, you've heard it. I'm going to say it again. The reason they are financing this with debt is because if you're the Ellisons or whomever, and you're in the C-suite and you're looking at this and saying, I've got a 250 stock, or a week ago, a $280 stock, I can finance these data centers by issuing stock that I think a year from now would be $350 and give up a 25% gain, or I can go to the debt markets where they're willing to lend me money at 5 to 6% depending on the maturity. I wonder what I'll do. And the reason they're able to borrow at 5 to 6% maturity is because of the cash flows that they already have. Sure, there's questions about how low or how high those cash flows are on these data centers, but the fact of the matter is they're positive, and that's what's paying off the debt. So really, to me, this is kind of a no-brainer. Again, as I've said many times, corporate finance 101.
All right, we're going to get to the broader AI trade in just a minute, but right now we want to kind of dig into one of the names really leading to the downside today. Of course, that's Palantir. Pulling back despite a strong earnings report and strong forward guidance. Our Seema Modi joins us now with much more and also some colorful comments from Alex Karp today right here on CNBC.
That's exactly right, Frank. Palantir really hit the ball out of the park with Q3 earnings. That's the view from a majority of sell-side analysts that cover the stock. The only challenge is how to value Palantir and how much of its growth is already priced into the stock. Jefferies writing that the numbers are great. Valuation is, quote, extreme at 83 times 2026 sales. Cantor Fitzgerald writing that we continue to be impressed by its products, business model, execution. Our neutral ratings only informed by relative valuation, adding that Palantir trades at about 5 times higher versus other names in the infrastructure software sector. CEO Alex Karp joined CNBC. Here's what he had to say about valuation.
They thought Palantir was overvalued at 10. They thought it was overvalued at 20. I'm not even here saying what the valuation is. I'm just saying find a company in the world that has a rule of 114, that has U.S. commercial growing at 121%, that aggregate growth in the U.S. is 77%, that has throwing off free cash flow in a way that's anomalous, and that is fully aligned with our customers.
Karp also blasted Big Short famed investor Michael Burry of Scion, who revealed in a filing last night that he's shorting Palantir and NVIDIA, to which Karp said, quote, the idea that chips and ontology is what you want to short is crazy. Going forward, investors will be watching government revenue growth for Palantir, which did decelerate slightly from 53 to 52% quarter on quarter. Jefferies analysts add that the ongoing government shutdown likely lowers the number of new contracts getting done, Frank.
All right, our Seema Modi with the very latest on Palantir. Those shares, one of the biggest drags on the S&P right now. Joe, I want to come over to you. You're a Palantir shareholder in the Joe T ETF. What do you make of the reaction in the stock after very strong earnings? I do want to point out there was also a warning on a Korean exchange about SK Hynix that seemed to spook the markets in addition to those comments from the Morgan Stanley and Goldman Sachs CEO. But what do you make of this reaction?
Valuation was the impediment. I said it yesterday. 85 times sales, 200 plus times earnings, and apparently this morning the marketplace is paying attention to that. Now, if there's something embedded in the earnings report for you to be particularly troubled by, I mentioned yesterday that I thought the international expansion was very favorable. Well, to hear Alex Karp say that growth is being held down by a stagnant Europe, okay, that's somewhat troubling. But I think overall, you have to look at this from the perspective of how do you think about positioning here? And unfortunately, in fantasy land, it's very easy to say, okay, I'm going to make money being long, or guess what? I'm going to make money being short. I think probably what's in front of you is that both sides are going to be disappointed, both the longs and the shorts. If you have the ability to be really fast in markets and go in there and, you know, take a short position, I think the high yesterday was 207. That's the all-time high. If you think this stock could fall 150, 160, okay, great. Congratulations. You probably should be managing a hedge fund. But that's very difficult to do. If you're thinking about selling short on the premise that this stock is going to go back down to $40 or $30, the fundamentals just aren't there to suggest it. So, look, we entered this stock in January of 24 at $16. Frank, we have an 1,100% gain in it. And the reason that we entered the stock had nothing to do with me being a genius in analyzing the balance sheet and fundamentals. It had to do with momentum. And I'll be very candid about that. And the momentum has remained in place in this stock. And I don't know where we're going to exit. I never anticipated we're going to have an 1,100% gain. I don't know. Maybe the gain's going to be hopefully 400% or 500% by the time we're out of the stock. But momentum guided us in and momentum's guided us out. And I'm going to be very clear about that. And I think ultimately, when you're looking at positioning in this stock, you have to understand that this might be entering a period where it's going to disappoint everyone and move in a sideways pattern after these earnings report.
You know, Joe, I want to come over to you. You're saying if you're looking for something to nitpick,
Order
some of the
filled.
stagnation in Europe. But if you look at the U.S. commercial business, up 121% year over year, operating margin expanding quite a bit. It was over 50% this quarter, 34% a year ago. Doesn't that really overshadow some stagnation, I guess, over in Europe? I mean, the fact that commercial customers are adopting, and we know that Palantir has been one of the better performers using their boot camps to drive adoption. I actually talked to a number of companies that use their software. They seem to not only understand ontology, but just the use of this software. And a lot of them say it helps you expand margins, which is supposed to be one of the big base cases.
Nobody's denying any of that. There's not one person looking at Palantir saying anything about like the health of the business. Joe is exactly right. The entirety of the debate is how much growth have investors already pulled forward into the valuation that they're currently paying. This company is obviously on fire, and it's actually kind of weird to me how defensive Alex Karp seems to be, because people who are real investors in the AI space lionize him personally and worship this company's execution. Like, I don't know of anyone in the AI world that's like, Palantir, no big deal. People are losing their minds over how well this company's doing. What he's worried about is, I guess, a couple of people come on TV here and there, and they're bearish on Palantir because of the because of the stock price and the valuation. And he seems to be really fixated on that, but it doesn't make sense to me because they're killing it. Frank, all those metrics, and I have 50
Order
more in
filled.
front of me. No other company, to his point, no other company is executing at the level that they are in this space. And I guess like a more Buffett-esque response would be, we take care of the business, the share price will take care of itself, especially considering he said he has $880 million still on the buyback. Wouldn't you want the stock to come in? Unless you're issuing stock, okay. I don't even understand why you would want a higher and higher and higher valuation. You're buying stock back. Let people be bearish. Let people sell it.
Frank, if I could make one other point.
Yeah, go ahead.
The other thing that I've learned over many decades is when you have an individual equity name like this that becomes a battleground stock, that becomes so prominent in the headlines, it doesn't mean if you don't have a position, you have to engage. You have to take a position. In fact, it means the opposite. It actually is a signal to step away and let the marketplace do what it needs to do. Let the marketplace maybe work off some of the extreme valuation. Let those strong fundamentals, which I agree with that Josh is citing, come into play. But that happens over the course of time. And you don't need to race ahead of time and establish a position just because everyone's talking so much about it. That's detrimental behavior.
Yeah, by the way, while we're talking about positioning, Michael Burry has been on Twitter since some of these earlier reports come out. He seems to be saying he's not shorting the stock. He has puts, almost $1 billion worth of puts. He kind of put out some funny tweets about that. So I think a lot of people have been saying shorting, including Alex Karp, but it's puts about $1 billion. He also seemed to reference the 13Fs perhaps being backwards looking. So, Jim, I want to come over to you with that in mind.
Yeah, I think what I felt kind of like Joe and Josh were talking to me as a typical investor who's not in Palantir, and I thank you guys for that insight.
Jim.
No, but Josh, I mean, you know what I'm about to say, right? First off, Mr. Karp and Mr. Burry both have eloquent points, and they both might be right. It's a question of timing. For somebody in my shoes who doesn't own it, the problem is I can't take investors' hard-earned money and put it to work at 200 times earnings on the fear that it goes down to 120 times earnings, and those investors turn to me and say, well, why did you buy it at the price you bought it? And I don't have a good reason other than momentum, which has worked very well for you, Joe, and I compliment you continuously on it. It works for you. It is your style. But I do want to address something. You know, I just said that both Mr. Karp and Mr. Burry can be right. The thing about Mr. Burry that viewers need to understand, he is so well practiced in waiting, far more so than the average viewer and the average short investor is used to. So he's out here saying, yeah, I'm just buying puts. There is a cost to puts. And, you know, those puts expire, and then you have to decide to re-up them. Mr. Burry, as I said, has an exquisite track record, and there's a great movie, The Big Short, in which, you know, this is on display of waiting. The average investor can't wait that long, and that's why shorting, or in this case buying puts, is awfully dangerous for a stock that's growing earnings per share at 50%.
Burry is also very responsible. He tells people, I'm not your financial advisor. Don't follow me into trades. There's a lot of people who get personal satisfaction out of being very publicly right and tweeting out a position and just saying, watch this, and not saying, come do this with me. And I like that Michael Burry comes out and says, guys, this is not a game that you should be playing with me, but I still want to tell you what I'm doing. He also says, he's been wrong like everyone else on earth. And he says, I was wrong. He said, go to cash in the middle of last year, right before like one of the biggest phases of this bull run. I think he had puts on NVIDIA in January that he was talking, like, it doesn't always work out. Filled. He's willing to be public with his positions. Maybe it's interesting to some market participants. But if you think he's your financial advisor, dude, you're losing perspective. It's just a guy doing his own trades.
Order filled.
Even more for warning people, this is not a game for everybody to be playing.
All right, Josh, since you say you respect Dr. Burry very much, you mentioned his puts on NVIDIA back in January. He actually put some puts on NVIDIA this time around as well, according to 13Fs. Not clear on Twitter if he's trying to dispute whether that's his current position or not. What do you make of that, the idea that he's also basically, it really seems like he's putting puts on the big money makers in the AI economy, both NVIDIA and Palantir?
Dude, correction because the Mag 7s start to come in with all the rest of the market, which I think is sort of what's in progress right now. That position could look incredible, but long-term investors would look at it like, wait, the stock came down 20 points after going up 100 points. Who cares? So there's room for multiple people to be right on different time frames. The other thing to keep in mind with 13Fs, here's how it actually works. The quarter comes to a close, and the filers have up to 45 days to disclose what they did during the course of that quarter. So intra-quarter, people could be in and out of positions and not even have to report them at all. So once again, no one's going to tell you, I bought this and here's the exact time I'm selling it. So, like, it's really, really difficult to try to follow a professional and do exactly what they're doing.
Order
and
filled.
I really don't think most people should even be attempting to do so.
All right. Speaking of right or wrong, Joe, I want to come over to you, also an NVIDIA shareholder. Broadcom named the new top semis pick at Jefferies. It's actually replacing NVIDIA.
It is, and you have two names that you need to focus on here over the next 30 days. One of it, obviously, being Broadcom. It is captured a significant amount of market share along with NVIDIA.
Order filled.
The other name that is of interest is AMD, and AMD is going to be reporting earnings with after reporting earnings this evening, after having a remarkably strong October. The month of October, the stock was up 58%.
Order
It hasn't
filled.
done that in well over 20 years. So if valuation is going to matter once again and again, valuation is not how that's not the lens of which I look through markets, but there are others that do that. And there are cycles that we go through in markets where markets prioritize that type of strategy. And I think what Josh said earlier in the show, I think we are at an inflection point where the market is now looking through the lens of, okay, what's your valuation? So you look at AMD and you say to yourself, okay, wait a second. They're really going to have to prove themselves this evening. They're really going to have to show that the business, the revenue is strong with the big four. The big four runs somewhere around mid-teens for their growth, and that obviously being Amazon, Meta,
Order
Alphabet,
filled.
and Microsoft. But the valuation is a little bit high here. If you look at the forward PE, you're talking about getting into the upper 30s for AMD.
Order
and you might
filled.
be a little bit uncomfortable with that relative to where they've been the last several years. So
Stock is up 25% in the last month. They'll report earnings. It'll be an amazing quarter. It'll fall 5%, and the websites will write headlines like AMD disappoints investors.
Right.
It's like it's so moronic. It almost obviates our need to discuss it. Stocks go down on good news sometimes. That's not a signal that something's wrong. You have to have the context of look at this chart. Imagine
Wait,
this
Josh,
thing
let me
pulls
interrupt
back
you
after
for a second.
earnings.
We're looking at the chart,
Well,
Josh, but
Frank,
I know you say
thank-
stocks go down
thank you,
sometimes.
OpenAI.
Yeah, true. I know you say stocks go down
Order
sometimes. We
filled.
saw Meta go down quite significantly. Some people think it was that surprise charge. Other people think it's too much spending. Now we're seeing Palantir. If AMD follows this trend, when is it, or is also seeing that same pattern play out, when does that become a trend that is a signal of something?
Okay, so 10,000 years ago, a tidal wave would come up and wash away a village. And the people would say, oh, that's because Poseidon is angry because so-and-so didn't sacrifice a white ram on his birthday. This is what human beings do. We try to ascribe some meaning to some phenomenon that is not obvious. We try to come up with the story for why. Meta has, I don't know, has it tripled in the last 18 months? So, like, look, earnings season forces us into this kind of narrative mode because human beings get very uncomfortable when there's no rhyme or reason for things that take place.
Order filled.
We don't like randomness, and we look for answers. And I'm part of that. I'm on TV doing this for, I don't know, how long has it been? 15 years? So I get it. I'm not divorced from this, but I'm just telling you, a lot of times there are great expectations built into a stock, like Palantir. The company delivers, and the people who have benefited on the way up, they say to themselves, okay, that was great, but I'm not adding here. I'm taking some profit. It would be a mistake to go a step further and say Palantir disappointed investors with its guidance. It's just not the case.
Okay.
Sometimes the
Palantir-
case, not always.
Okay, fair enough. Palantir shares pulling back more than 7% right now. We do want to turn to D.C. with some breaking news. Let's get to our Emily Wilkins live down in Washington. Emily, what's the latest?
So the Senate has once again voted and once again failed to pass a stopgap that would have reopened the government. It's a very interesting split screen right now in D.C. because this is the 14th time that they voted on the stopgap that would fund the government only until November 21st. Meanwhile, I just spoke with a number of senators. There are an increased number of bipartisan talks underway trying to find a path forward to reopen
Order
the government.
filled.
It would be some sort of agreement that would include long-term funding bills for fiscal year 2026, along with a promised vote on those Affordable Care Act tax credits. Nothing is final yet, though, but the atmosphere in the halls of Congress is that they are a little bit closer to potentially getting a deal done, and that there's momentum here that we just haven't seen in previous weeks. Back to you.
Emily, welcome to the very latest on the happenings in D.C. Emily, thank you very much. All right, coming up next on Halftime, more of the day's biggest earnings movers. We'll start with the big pullback in Uber shares, and later Josh Brown's back with his best stocks in the market. Halftime's back in just 2 minutes. Welcome back to Halftime. Let's get to some stocks that are on the move. Uber falling despite beating revenue estimates. Josh and Joe, you both own it. Josh, you want to go first on this one?
Yeah, look, this is a company that's reported another incredible quarter. Profitability is growing. They've announced tons of stuff like deals with NVIDIA for autonomous. This will probably be the biggest platform for autonomous rides over the next 2 to 3 years as they roll out all of these various partnerships that they're working on. And I think that they have successfully made the point that the cross-pollination between Eats and rides is what really sets this business apart and what gives them innings and innings and innings left of converting more and more users to Uber One subscribers or to people who use both platforms. And that's been the story behind the stock. So it's up 60% on the year going into the earnings. Everything we just said in the A block now applies to these names in the B block. They come out, they report a great number. People see some profit taking and they say, Uber must have disappointed. Nobody who's an actual investor here is disappointed. They are literally crushing it.
All right. Josh says it's all about irrationalness. Joe, coming over to you. I am looking at the valuation on Uber, almost 30 times. Is that an issue here?
No, 15 times forward earnings. It's the cheapest. Find me another. How about this? Costco sells for 50 times earnings right now. Find me another $200 billion market cap company growing 20% as far as the eye can see into the future, selling at 15 times forward earnings. Find me one.
You got Josh
can't.
mad.
I can see. Josh, I'm just going by our system. Our system says almost 30. By the way, I didn't know you answered to Joe. I was going over to Joe with this. I think you guys play golf together, but now you guys answer each other's names. Joe, I'm coming over to you on this one. Josh says 15 times. Our system
not
says
30
just
times. Are you looking at trailing?
Forward. I'm looking at forward.
All right. No. So let's just go back for 1 second. Costco's getting punished, by the way, on that extreme valuation. Costco's not been trading well. We've been talking about that. You have a legal charge here for Q3 that ate into earnings. I think the street is looking at that. And in an environment today where it's clearly risk off, you have crypto under pressure and all the high beta names, you're going to see that Uber is going to be punished in that regard. I don't think it's being punished significantly. I still think the stock fundamentally is in a great place. The free cash flow expansion, to me, has been the real story over the last several years and the reason why I personally bought it a long time ago. Gross bookings were strong once again, and gross bookings coming up for Q4 should be strong as well. Q4 is generally their strongest quarter. So, I don't see anything to suggest that there's headwinds in the fundamentals other than the state of the market today and being punished for that one-time charge.
All right, Uber shares pulling back more than 6%. Moving on to Vertex, bouncing back from some earlier losses. Jim, you own this one.
Yeah, first the headlines. I mean, it was a beat and raise. I think the reason it was down earlier today was some concerns that they didn't raise enough. I think that's really missing the point. Maybe, if we talk about the stock price over the last year, it's been choppy. It's been choppy, and while it's up on the year-to-date about 7%, that choppiness has mainly been due to this new pain drug that's come out called Journavax. It's a non-addictive, non-opioid painkiller. It's approved, and there have been puts and takes about what indications it has been approved for and might be approved for, but ultimately, this is where I think the market is getting it wrong. I think there is a much greater runway ahead for how Journavax will be prescribed than what the market is anticipating. And at 21 times forward earnings, I know this is the valuation show today. I do find that is forgiving for a company that not only has Journavax, but has a core franchise in cystic fibrosis, to which there really is no competition, and has on the horizon kidney medications coming up. So I really like this stock.
All right, Vertex shares up just over 0.5%. Time now for some headlines. We have our Courtney Reagan. Courtney, good afternoon.
Hi, Frank. Stellantis is recalling more than 320,000 Jeep plug-in hybrids because of the risk that batteries could catch fire. Federal safety regulators say the high-voltage battery packs in Jeep Wrangler and Grand Cherokee models may have been built with cells that could separate and get damaged. The automaker is advising owners to park their vehicles outside and not charge them until the batteries are fixed. The recall includes Wranglers produced since 2020 and Grand Cherokees from 2021 through mid-October. Maryland Governor Wes Moore thrust his state into the national redistricting debate today by forming a commission that will consider redrawing Maryland's congressional maps. The 5-member panel will hold public hearings and make recommendations to the governor and legislature on proposed changes to the state's 8 congressional districts. Democrats already hold 7 of them. And England's former star soccer captain David Beckham became Sir David Beckham today. King Charles knighted him at Windsor Castle to recognize his contributions to sport and charity. Beckham was put forward for the knighthood 10 years ago. Back over to you, Frank.
All right, Courtney, thank you very much. Courtney Reagan with the headlines. All right, coming up next here on Halftime, Josh Brown is ready with his best stocks in the market. He's focused on what he calls the ultimate low-trust asset. Halftime's back right after this.
uh,